This is still a tech-driven market.
Large cap U.S. market itself has been the place to be.
In general, things have been drifting more positive.
Valuations are toppy, but generally firms are performing.
Valuation is always in our mind, but at the end of the day, valuation alone is something that doesn't end bull markets.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, doubling down on rate cuts. Weaker economic data reinforcing the case for dropping interest rates as Fed nominee Stephen Miron is gearing up for a grilling on Capitol Hill. Investors are putting additional weight on this morning's ADP report. That jobs number very much in focus.
And my question is, how does the market respond? Is it potentially more at risk from a strong number or a weak number? Because yesterday, I'm sorry, because I'm just trying to trigger the person next to me right now, but what we saw was bad news, was good news for the market. And what we saw was a JOLTS report that came in lighter than expected, caused a rally in bonds that allowed a rally in stocks to continue. So what do you make of what that means for today's ADP report?
Data this week hasn't been great. It's been JOLTS, it's been the ISM, Beige Book too. Lisa mentioned the Beige Book yesterday. That Beige Book did not make for good reading at all for this Federal Reserve.
There's no growth, or very little growth, and pretty much that's what you could see across the board. Not only that, but it's classic stagflationary type of dynamic, the idea of prices going up. Almost all of the businesses talked about some sort of inflationary pressure from tariffs. At the same time, they're not seeing expansion opportunities. You put this together, you say, okay, rate cuts, is that enough to juice demand and juice the animal spirits to come back? And that, I think, is what markets are grappling with.
So Stephen Miron goes to Capitol Hill, confronting some of these issues, no doubt looking for lower interest rates. He's got this to say: the FOMC is an independent group with a monumental task, and I intend to preserve that independence.
This is going to be his entire shtick today. Federal independence. He wants to be there to preserve it. He is going to make that point crystal clear. It's going to be very hot rhetoric when it comes to Washington, when it comes to Steve Miron, when it comes to the Democrats. They have made it very clear that they are going to go after him and basically make this a referendum on the Trump administration, what they say has a heavy hand when it comes to Fed independence. But this is an individual that was just confirmed in March, party line by Republicans. There is no question that Steve Miron will be confirmed. The question going in today is the timeline. Will he be there for September 16th?
Can he make a credible argument for lower interest rates without being accused of being a puppet? Now, who does he need to convince? It's not the senator from Massachusetts. He needs to convince the market that this is a credible pick for an independent institution. Forget the political noise in the room. It's about the market response to this pick that matters.
Which is the reason why markets will be watching this hearing. And right now, it doesn't seem like it matters to a lot of the Republican senators who will probably confirm him. To your point, Annmarie, he will be confirmed. What's his definition, though, of independence? Remember, he wrote a paper last year. He co-authored a paper saying that the Fed could preserve its independence by allowing the president to more easily replace him with a Fed member. So the definition of independence very much on the table.
Also, an open question is whether or not he will keep his seat at CEA. Can he even do that? Or when the term is up at the Fed, will he go back to the CEA? Speaking of that paper, he wrote with Dan Katz, who's the chief of staff of the Treasury Secretary. They talked about the revolving door in Washington between the Fed and the executive branch. Well, he would basically be part of that revolving door. Then in this paper, he argues there should be a four-year window.
He could do both, can't he? How many jobs has Rubio got right now? Just sort of tally them up.
At least three.
And he could build homes.
Yeah, exactly. Last week at the cabinet meeting, it was Marco Rubio. He said, I'm really going to be enjoying this Labor Day because I have more jobs than I've ever had.
If you are just tuning in, welcome to the program. Equities right now positive by 0.2% on the S&P 500. Busy morning coming up. This hour we'll catch up with Stuart Kaiser of Citi. With stocks looking to add weight to the recent rebound, we'll speak to David Wilcox of the Peterson Institute as President Trump's pick for the Fed heads to Capitol Hill, and Mike Pyle of BlackRock on the loss of macro anchors. We begin this hour with stock steady as investors await the latest read on the US labour market. Stuart Kaiser of Citi writes the following: the bar is fairly high for investors to move into lower quality stocks given economic uncertainty. Stu joins us now for more. Stu, good morning.
Good morning. How are you?
Typically, I wouldn't be teasing ADP, but this morning I'm teasing ADP. How important is that data point now?
I mean, markets don't react too much to ADP, but, just given the overall messaging going on. I mean, claims more important than ADP, but probably both important. You've kind of had a string of, not bad economic data, but I guess I would call it kind of questionable economic data. And yeah, there'll be a focus on it. But again, it's kind of second-tier labor market data, I would say.
First tier tomorrow.
Yes.
Are you expecting strength or weakness?
I mean, consensus is 75K. Our economists are 45. So, the House view is a little bit to the weaker side. 45 or 40K are probably the bare minimum equity markets are willing to accept. I think anything below that, you'll probably get a bit of a pullback. But, tomorrow, I think, to Lisa's point, is all about rate cut expectations. And tomorrow can maybe get you to pricing more than a full cut. I don't think it can get you to pricing less than a full cut. I mean, you would need just an absolute blowout number to the upside. And given the recent momentum of labor market data, it's going to be very hard to get you sort of sub a full cut. If you printed really weak, you probably get, a cut and a half priced or something like that.
I was trying to trigger you earlier. Did I succeed?
I thought you were trying to trigger Annmarie.
No, I was trying to trigger you because ultimately you've always said good news is good news and bad news is bad news. And what your call is essentially reiterating that. Don't go down in quality unless you believe that the economy is really going to kick off. But isn't what we saw yesterday in terms of the response to the JOLTS data an indication that bad news could be good news in terms of spurring rate cuts and allowing the market to really get those animal spirits underfoot?
I mean, the very tactical reaction to that might be positive, but big picture, if the labor market is slowing considerably and the Fed feels kind of behind the curve, then that's negative for equity markets because it's very hard, to your point, for them to cut enough to kind of, rescue the economy or bail the economy out quickly. So, we're still if you get a bad labor market report, that's negative for U.S. equity markets. And you also use the word stagflation, and I wouldn't consider stagflation to be good.
Well, okay, maybe not now, but if there is a feeling of growth that's juiced by a Fed that might not be responding exactly and only to the economic data, but also to political pressure, does that unleash something new for you that might be positive, at least in the short term for stocks, albeit potentially really negative in the long term for bonds?
I mean, look, again, if the Fed is cutting for any reason that is, A, they're being forced to, i.e. policy is not consistent with the dual mandate, that's negative. And if they're cutting because labor markets are weak, I think that's negative. A little bit of what you got yesterday, too, I think was not all related to the data in the U.S. Foreign bond yields kind of stabilized in the U.K. That allowed U.S. yields to kind of stabilize as well. So I think you got a little bit of that reverse spillover, however you want to think about that. So it was a little, my view is it wasn't that much about the data because I don't really think you saw a meaningful change in the pricing of September cuts anyway on the JOLTS data. I mean, 2-year gilts were down, about 4 basis points. So there's something there. If you want to talk yourself into a bullish story, but again, the real bullish story here is that economic growth is you print 125K jobs and the beige book surveys start to skew a little more positive and you actually have like a real growth impulse. If you're printing negative jobs data, an extra 25 basis points isn't going to help the market, I don't think.
When it comes to the data, you called tomorrow's data first tier. Is it put into question, though, given the fact that the President of the United States basically says he doesn't believe the BLS numbers anymore and wants to putting a new commissioner at the top of the institution?
Well, and that's why September 9th is important. I think September 9th, you get BLS revisions, and it's going to be very interesting to see what they do there and how President Trump reacts. I mean, the market has to react to the data that's in front of them. Some might argue that ADP is cleaner than BLS data because that's actual, people on ADP payrolls.
But is that why ADP has taken on this new importance because of the political overhang on the BLS?
I think that's part of it. And also, like the last year or so, ADP is typically printed a little bit weaker than BLS jobs data. And then you've had large negative revisions to BLS jobs data in the future. So it actually looks like ADP, it almost looks like the BLS data has kind of converged to ADP. So that's probably helped it as well. I also think you're in a market that right now is much more comfortable with quote unquote alternative or new sources of data. And I don't know if I'd call ADP that, but it's a little more in that direction.
You alluded to it. We've been talking about it around the table, the sneaky bull case. What is the sneaky bull case going into year end?
I like the sneaky bull case to me is corporate America kind of, went on siesta for 3 months as we dealt with tax, tariff, and immigration uncertainty. And, as you may know with budgets, if you have a 2025 budget, it needs to be spent in 2025. So that would be your bull case, I think, is corporate America says, all right, we have the tax and spending bill passed. We have a little bit more clarity on tariffs, and hopefully the immigration uncertainty is a little bit lower, and that allows a little bit of a spending and hiring, kind of upside. We'll see. Obviously, if you look at, earnings were pretty decent. If you look at going into the earnings season, consensus was like mid-teens, Mag 7 earnings growth. We got mid-20s. Consensus is at about 2.5% S&P 493 earnings growth, we got like 8%. So there is, an earnings story there. Earnings guidance was very positive. 40% of companies guided positive. So if you're willing to squint and take a leap of faith here, there are some positive trends on the corporate side of things. And to me, that is the big bull case. You get a little bit what you got last summer, which is a 3-month slowdown followed by a 6-month rebound.
A lot of business owners are thinking about that sneaky bull case. And I was speaking to one yesterday who was saying that actually if there's a 50 basis point rate cut or 225 basis point rate cuts, that could be enough to really start to unleash some of this activity. What do you think would be required in terms of the landscape for that sneaky bull case to come to fruition?
Honestly, I think almost like a base case on the economy might be a bull case for corporate America, i.e., we're slowing down but not going into recession. You get a couple, quote unquote, insurance cuts behind that, and inflation is sort of sideways. I think if you got all of that together, corporate America is going to say, okay, I have a little more policy uncertainty. I'm not in a recessionary economy. And they were willing to give me 50 basis points of cuts at year end, and maybe that makes me more confident to do my investing. Like if you look at the small business surveys, optimism spiked after the election, and then uncertainty spiked after the election, and both of them kind of got to near 50-year highs, call it. So you're in a situation where businesses wanted to be optimistic, but they were super uncertain about the outlook. What's going to win, I guess, is the question there, right? Now, if you get uncertainty down, the optimism wins. If uncertainty stays where it is, that's probably going to win out. So a little bit of a balancing act there between I'm excited, but I'm scared.
What you described sounds a lot like what we saw play out last year. Had a labour market head fake through the summer. Fed comes out, gets nervous, drops rates 100 basis points. The question this time is whether this is really a labour market head fake or the real deal, because the data that keeps coming in keeps supporting that it might be the real deal.
It's frustrating to tread water for 3 years. And that's sort of what people have been saying for a long time. Wait for the breakout. And ultimately, the breakout hasn't happened economically. It has happened from a stock market perspective. And this is just adding to the tension that people feel. It's sort of this pent-up demand to be optimistic because we're Americans. But on the flip side, this question of uncertainty that just dampens it down. And that treading water, it's exhausting.
There has been a cyclical tilt to this equity market in the last month or so. This market is positioning for a pickup in economic growth. We're waiting for confirmation. Will we get it this coming Friday?
And will 25 or 50 basis point of rate cuts give that sort of animal spirits to that cyclical aspect of the market? That ultimately is what a lot of people are betting.
I'm long the economy. I hope you're right. Stuart, it's good to see you.
Good to see you.
Stuart Kaiser of Citi. Thank you, sir. Equity's doing nicely, up about 0.2% on the S&P 500 with an update on stories worldwide. With your Bloomberg brief, here's Yahara Anand. Hey, Yahara.
Hi, John. Tech industry leaders are heading to the White House today. CEOs from Meta, Apple, Microsoft, Google, and more are all expected to attend an AI event hosted by First Lady Melania Trump. It will be followed by an evening reception with President Trump in the newly renovated Rose Garden, which you can see there. Meanwhile, Salesforce shares are falling more than 6% in the pre-market after the software company issued weak revenue guidance, suggesting its AI product isn't yet paying off as quickly as hoped. But CEO Mark Benioff remaining optimistic, telling analysts on the call, this is just the beginning of the most transformative time in our industry. And sticking with tech, Apple is gearing up to launch its own AI-powered search tool next year as it tries to compete with OpenAI. Sources telling us here at Bloomberg it will be built right into Siri and eventually its Safari web browser. And some of the underlying technology could even come from Google. Apple is targeting a spring release, part of its long-awaited Siri overhaul. That's your Bloomberg brief. John?
Yahara, thank you. The name's questionable, isn't it? What do you make of that?
World knowledge answers. It's like World Wide Web. I'm one of the kids. Look at me.
I'm guessing that's just an internal name for it, right?
I hope it is, because right now it's being blasted. I'm sorry, it doesn't roll off the tongue.
Sure.
WKA.
Yeah.
It's not cool.
We'll come back to that later in the programme.
Maybe.
Up next on the show, Trump's Fed pick facing a grilling on Capitol Hill.
He would like to see Stephen, who I've known for a long time, get on there as soon as possible. By putting Stephen Myron in, that gives us more time.
Up next on the programme, we'll catch up with David Wilcox of the Peterson Institute, live from New York City this morning. Good morning. Snapping a two-day slide on the S&P 500 in yesterday's session this morning, adding some weight to the bounce back, up 0.25% on the S&P, up 1/3 on the Nasdaq 100. Under surveillance this morning, Trump's Fed pick facing a grilling on Capitol Hill.
The president has great sway with Leader Thune. Leader Thune's been a great partner during the tax deal, and I think that he would like to see Stephen, who I've known for a long time, get on there as soon as possible. By putting Stephen Myron in, that gives us more time. And again, I want to cast a wide net. The president's very open-minded.
So here's the latest this morning. The Senate holding an accelerated confirmation hearing this morning on Stephen Myron's appointment to Federal Reserve Governor. Myron saying in prepared remarks that he intends to preserve the independence of the institution. Joining us now in Washington, D.C. is Bloomberg's Tyler Kendall. Good morning, Tyler.
Hey, John. Good morning. Well, you said it there. We're expecting Stephen Myron's nomination to proceed on perhaps an expedited schedule with this first step today, his hearing in front of the Senate Banking Committee. And while the spotlight will be on Myron, this is also giving us a rare glimpse into how Senate Republicans are balancing their past calls for Fed independence with their current support of President Trump and what many of them have said is his right to voice his opinion when it comes to monetary policy. Now, Stephen Myron's going to have to make a credible case to lawmakers that he's the man for the job, and we sort of got some insights into how he's going to frame his messaging. In prepared remarks that he's expected to read at the top of the hearing, he says that he will preserve the Fed's independence. You read one of the quotes there, but I'll highlight another. He said that independent monetary policy is critical for its success. But the thing is, Myron has previously called for greater presidential control when it comes to monetary policy. In a paper written last year, I know you spoke about it at the top of the show, he advocated for some perhaps more controversial changes, including shortening the terms of Federal Reserve governors and also subjecting the central bank to the congressional budget appropriations process, something that just isn't done. Now, for context here, Myron was confirmed to his current post in a 53-46 vote earlier this year. That means that 4 Republicans would have to vote against him in order to sink his nomination. And at this point, that doesn't seem likely. And Democrats can see to us privately that they realize that there's not a lot of procedural moves that they can take that would delay this vote until after that September meeting. Now, John, I did catch up with a senior Democratic aide to Senate banking leadership yesterday, and they pointed out that there are other nominees that are going to be at this hearing, but they told me to expect every Democratic member to gear their questions towards Myron exclusively.
Tyler Kendall with the latest. More from Tyler in the next hour. Tyler, thank you. Joining us now to extend the conversation, David Wilcox, the senior fellow at the Peterson Institute for International Economics. David, welcome to the program, sir. If you had the opportunity, if you're in that room today, what would be your first question for Stephen Myron?
My first question would be, gee, it's interesting that you're marketing yourself as an advocate of Federal Reserve independence, given, as Tyler just mentioned, that your paper is chock full of ideas for how to undo the guardrails that currently protect the Fed from day-to-day political fray.
There's also, David, in that paper, some ideas from Steve Myron and Dan Katz that would actually make the Fed potentially, some would argue, more independent. This idea of short-circuiting what he calls the revolving door between the Fed and the executive branch, which we've seen under Democratic administrations like the Biden administration when it comes to Janet Yellen and Lael Brainard. So can't you make the argument that actually he has ideas that do fortify Fed independence as well?
I think that's a tough argument to make. The reason why is because he would make not only board members in D.C., but also Reserve Bank presidents scattered around the country, subject to being fired at will by the President of the United States. And he and his co-author, Dan Katz, go so far as to admit that the likelihood is that when a new president came into office, they would probably clean house and start with a full new slate of Federal Reserve policy leaders. That would introduce an element of discontinuity into monetary policy that we just haven't seen. The tradition at the Fed has been much more for continuity, nonpartisan analysis of monetary policy and the longer-term economic interest of the country.
Since many think he's going to be confirmed, given the fact that he was confirmed on party line votes just months ago, what are you going to be looking out for today when it comes to this hearing?
Well, I'll be interested to hear what he has to say about whether he stands by these institutional changes that he would make to the Federal Reserve. He won't have a lot of leverage in that regard because that would take an act of Congress. I'll also be interested to hear how he will balance the dual concerns of the Federal Reserve. On the one hand, maximum employment, and on the other, price stability. Another area for inquiry, it seems to me, with senators is Myron's repeated statements that there's no evidence of any pass-through whatsoever of tariffs into consumer prices. That's got to strike the ears of senators as a little peculiar. I'm sure they're hearing from constituents that selected imported items are experiencing marked price increases.
Do you think, David, that it matters if Stephen Myron is confirmed, considering that he's only going to be there for a couple of months and he's only one voice?
He's a placeholder. It will be an important voice. It'll be a bellwether of where the administration stands. It takes President Trump one step closer, though, to having a tipping point in terms of control over the Federal Reserve governance structure as a whole. With 4 members of the Federal Reserve Board, he will be able to, if all 4 are willing participants, he'll be able to radically change the decision-making of the Federal Reserve. Myron would be number 3, but this is why the struggle over Lisa Cook is so hugely consequential, because if President Trump can succeed in ousting Cook, that would be number 4. And I should mention, by the way, yes, I am affiliated with the Peterson Institute, but I'm also a colleague of yours at Bloomberg Economics.
Thank you, David, for that. I'm wondering if we're looking at this the wrong way. If you take a step back, I wonder if the independence of the Federal Reserve has been inherently compromised by how much debt the United States has incurred, and the fact that the Federal Reserve sets interest rates at a time where the maturity profile of that debt is getting increasingly short-term. In other words, they have more control over how much interest the United States pays. Isn't that inherently going to be political going forward, regardless of who is the president?
I don't buy it. What we learned from Paul Volcker in the 1970s and early 1980s is that a determined, focused central bank can exercise the tools of monetary policy operating in the environment that it finds itself in. Volcker was dealt a very difficult hand. He came in at a time of raging inflation, huge oil price shocks. His predecessor by 2, Arthur Burns, had pleaded he was powerless. He couldn't change the situation. Volcker came in determined to prove Burns wrong, and that's exactly what he did. It seems to me that this current situation with a lot of debt, with fiscal policy undeniably on an unsustainable trajectory, is somewhat similar. That complicates the environment for the Federal Reserve. It doesn't absolve them of their responsibilities to deliver good inflation performance and maximum employment.
David, appreciate your time, as always, and hopefully we can follow up after this hearing. David Wilcox there of the Peterson Institute and, of course, of Bloomberg Economics. Have we seen evidence of a de-anchoring of inflation expectations? I would keep going back to that. Yes, there are reasons to be concerned, absolutely, but has any of this contributed to a de-anchoring of inflation expectations?
So far, no. And you could say that based on break-even rates. You can also say that on the fact that inflation expectations over the longer term have actually come in over the past 6 months. However, there are an increasing number of analysts saying that this is an increasing risk. And that's the reason why Goldman Sachs sees gold potentially going to almost $5,000 by the middle of next year if there is a real de-anchoring of that. So it's still a threat, but it's not getting priced in any meaningful way.
Not understating the risk here whatsoever, but I think just taking the temperature of things right now in markets, things aren't boiling over in quite the same way as they are in the world of economics.
And a lot of the belief here is that the markets will act as the ultimate check. They're the adult in the room.
Absolutely.
And essentially, if there is a nominee who is going to act in a way that would on more inflation expectations, you'd see that response, and then there'd be a response to the response, and that's, I think, what a lot of people are betting on.
We'll get to that gold call in just a moment from Goldman Sachs. Coming up on the programme, we'll also speak to Brooke Roach of Goldman Sachs from the Goldman Annual Retailing Conference on the state of the consumer. Plus, Danny Berger with your morning movers, with Hewlett-Packard shares rising on earnings and revenue beats. The bounce continues, positive by 0.16% on the S&P 500 after snapping a two-day slide in yesterday's session. Up again on the Nasdaq by 0.24. In the bond market, 2-year, 10-year and 30-year. 2-year bond yields near the lows of the year, down 2 basis points this morning at 359.60. In yesterday's session, a double-digit range on a 30-year bond yield, getting close to 5%, then backing away. 487.45 this morning, down another 2 basis points. And Lisa, you said it. The tension eased off the back of weaker than expected data in yesterday's session.
We saw bond yields swing in a range that we haven't seen since the payrolls report in the beginning of August, just on the heels of the job openings report. And yes, job openings fell to the lowest pace going back to September of 2024, but it highlights how attenuated this market is to any kind of weakness that would unleash that type of Fed easing that people are expecting.
Things settling down so far this morning in the bond market. Let's turn to gold. Bramo mentioned it. 7-day move on gold coming into Thursday. Longest winning streak of the year so far. Just a little bit softer this morning, but still up on the year by about 35%. Goldman Sachs talking up the possibility of $5K on gold next year with this simple line from Samantha Dowd at Goldman. Gold is a store of value that doesn't rely on institutional trust.
And they are saying that it could reach almost $5,000 by the middle of next year if just 1% of current privately owned U.S. Treasury holdings were to migrate away from that asset class and into gold. A lot of people considering this as you see central banks around the world increasingly doing exactly that. It's fair to remember before you say, wow, they really have something to sell. It's fair to remember that gold has doubled in price since the end of 2022. Doubled, more than doubled.
Yep.
So it gives you a sense of how much scope there was to run and maybe what's to come.
And a move continued through 2025 so far. Just a little bit lighter, softer this morning. We're down by 0.5%. With 3 hours to go until the opening bell, let's get you some morning movers. Let's cross over to Danny for more. Hey, Danny.
Hey, John. Some tech earnings after the bell yesterday to get through. Let's start with the good, and that was HPE, Hewlett-Packard Enterprise, reporting earnings that beat on most metrics. But the real concern for them had been margins, considering that they were thinning out. But HPE, the CEO, coming out and saying, with AI-driven demand, we are weathering the margin slim down. We're going to go from something like 6.4% to 10%. Meanwhile, some of the more ugly tech earnings, among them Salesforce, those shares down 6.6% in the pre-market this morning. The company giving a lackluster outlook for growth. The concern for them is that they haven't had as many customers take up their AI products as had been hoped, or the more emerging AI market players being the ones that are upsetting them. Can they really capture that audience? Meanwhile, we also had earnings from Figma, their first set of earnings since going public. Shares down a whopping 14.5%. Let's just remember where the bar is. This is a company, a software design company that's doubled since its IPO. So investors were expecting a lot. It gave a forecast that was in line for expectations. This is what in line gets you a big decline, John.
Danny, thank you. Down almost 15%. You want a big mover? American Eagle in the pre-market. What a move. Up by 24% in early trading.
Thank you, Sydney Sweeney. Evidently, that really had some legs, and they saw their shares skyrocket. They had better than expected earnings, and it seems like no controversy is bad controversy when it comes to retailers.
The timing with Travis Kelce as well.
Oh, yes.
They timed that perfectly.
Oh,
what a coincidence.
You're a conspiracy theorist.
What a coincidence.
Oh, is that right? Would you like to share your thoughts?
Absolutely not.
All right, then, let's move on.
Stock is up in the pre-market by 24%. On our radar this morning, President Donald Trump asking the Supreme Court to uphold his global tariffs after an appeals court found them illegal. Trump asking the court to take up the case on a highly expedited schedule with arguments by early November.
So if you look at this submission to the Supreme Court, basically the administration is saying it's too big to unwind, it's too important to unwind. They say it eviscerates a critical tool for addressing these emergencies, for these negotiations with trading partners. And this is what was interesting. The Treasury Secretary in this ruling, in this submission to the Supreme Court, is talking about how it's already impacting ongoing negotiations. Quote, world leaders are questioning the president's authority to impose tariffs, walking away from or delaying negotiations, and are imposing a different calculus to the negotiating positions. So at this moment, even though the market is waiting for a final decision, what you're hearing from the administration is that it's adversely affecting their negotiating process with all of these countries, namely like India, that are still trying to get to a trade deal.
I want to know about the money, how much money they're counting on to come in from the tariffs, what it means for them to have to give back tens of billions of dollars. That's what I want to hear in these discussions.
Tens, try hundreds potentially.
Hundreds of billions of dollars.
Yeah.
I mean, they said the CBO estimates that there's going to be $3.3 trillion of tariff-related revenues from 2025 to 2035 if, and this is a pretty big if, they stay on at the current rates.
And can you imagine unwinding all of that money? Also, interesting to note, when it looks at what is going on in terms of if you have to unwind it, estimates from the Tax Foundation said tariffs are at risk in the case to account for about 70% of projected tariff revenue in 2026. So what does this mean for those individuals who are actually looking at tariffs as good in terms of bringing down these deficit concerns? All of that can be unwound at the Supreme Court.
That's an ongoing story in the nation's capital. This is going to be front and centre later this morning. President Trump's pick for Fed Governor Stephen Miron heading to Capitol Hill for his confirmation hearing later on. Miron saying he intends to preserve the independence of the Federal Reserve. Elsewhere, a congressional stock trading ban gaining momentum after a bipartisan group of House lawmakers agreed on a new bill. The bill's supporters spanning the political spectrum from Chip Roy of Texas to Alexandra Ocasio-Cortez of New York. Can we finally make this happen?
I think it's going to happen. The issue, of course, is that you have to have leadership put on the floor for a vote. You have individuals like Congresswoman Anna Paulina Luna saying, I'm going to force a vote on this measure if the GOP leadership does not put it to the floor. We should know this is for senators, this is for congressmen and women. This does not go to the executive branch, which a lot of people are speculating this is because the president wouldn't want to sign something that goes to the executive branch. But, Jonathan, everyone is going to point to what is going on with some of these Congress people. How many examples do we need to have to see that you see individuals in Congress taking advantage of what is going on, that they have what some would call inside information, and then executing?
So much doubt. Maybe they're just phenomenal traders. I've asked that a few times. Perhaps Nancy Pelosi is just a phenomenal trader.
And her husband, too. I think
phenomenal.
So. Well, I think
also Marjorie Taylor Greene. Marjorie Taylor Greene as well.
That's your theory. You're going to go with it.
People have got their doubts about that.
Yeah, they can go to, Wall Street.
That's the latest on Washington, D.C. Let's turn to the economy and to retailers. Macy's surging 20% in Wednesday's trading following an upbeat forecast on the consumer. The retail team at Goldman Sachs writing, quote, while there continues to be concerns around spending behaviour, we remain cautiously optimistic going into 2026. Joining us now from the Goldman Sachs Global Retailing Conference is Goldman's lead apparel analyst, Brooke Roach. Brooke, welcome to the programme. Let's just talk about this. So, the retailers are talking up a better story. The economic data is not so great at the moment. What's the call from you and the team?
Good morning, and thank you. It's great to be with you this morning from the Goldman Sachs Global Retailing Conference. This is our 32nd annual conference, and we're with nearly 80 companies talking about strategy and what's happening in the state of retail. Bottom line is that the consumer remains resilient.
This is what we're hearing from a lot of different companies. And yesterday I was there and I was speaking with one CEO who said it's sort of like a flat surface, a hard surface. Under the hood, there's a lot going on and a lot of molecules that are kind of battling each other, but it all comes together to kind of a flat surface. What are people looking at that could potentially break it to the upside, this sort of stealthy bull case that we keep hearing about?
That's a very good question. I think overall, as we put together all of the various inputs of what might be driving consumer discretionary demand on a go-forward basis, we see a better outlook into 2026, with discretionary cash flow modestly stronger across income quintiles and with some real opportunities for consumers to engage with great product and great retailers. What we're seeing overall is that trends have been better throughout the back-to-school season. And this strong back-to-school season start is much better than expected. And I think there is a view from many retailers that there is some cautious optimism that hopefully this will continue. But I think retailers are very cognizant that there is a tougher comp ahead and that there is some uncertainty on what the pricing backdrop might mean and what that might mean for consumer engagement from a demand perspective. The good news is that we haven't yet seen price elasticity of demand, and back to school has been strong. So what could break it? I think there's a lot of questions on what could be the case for consumers in terms of their mood or what might be happening, but we believe that the outlook is fairly robust.
What you just said there is actually really important, the idea that a lot of these retailers are increasing prices and people are still buying. In other words, they still have the power to increase prices and it's not destructing demand. And you're seeing that pretty much across the board. They're able to raise prices in select ways. Do they have a sense of whether this is coming from wealthy individuals, whether this is coming particularly from more luxury sectors, or whether this is across the board through all the tiers of different income levels?
I think at this point, retailers are trying to do their best to protect the consumer and to protect their businesses, but they are seeing some cost increases overall. At this juncture, we've only seen modest price increases across the board based on what retailers are telling us, but there is some question about what that price might look like into the back half of the year. As we think about that, the change so far, given that it has been modest and it hasn't been broad-based across the board, as far as what retailers are saying right now, consumers have been able to absorb these price increases. They do have higher discretionary cash flow in their, they do have a stronger wallet right now. And so far, it does appear that many retailers are looking to try to do it in a way that won't hurt the consumer, whether that is a mix shift into different types of products or categories or otherwise.
Brooke, before you go, can we lend some thought to the idea that maybe the C-suite, I think, is struggling with this cultural moment in America as well? I'd love your thoughts on this and what you're hearing from management teams. I'm thinking more recently of Cracker Barrel almost blowing itself up, American Eagle leaning into controversy, and it benefits them. The stock is up nicely in the pre-market so far this morning. What's your understanding of how the C-suite is wrestling with this moment?
You know, I don't know about your specific examples that you gave, but what I would say is that retailers are focused on engaging with their core consumer. They're investing more in marketing. They're looking to try and create better products that will drive strong consumer demand regardless of what the macro backdrop looks like. And we're seeing more and more retailers lean into that. And we heard that a lot yesterday with various comments about marketing, consumer engagement, and great new product.
Brooke Roach of Goldman Sachs. Brooke, appreciate it. Thank you. Two well-known examples in the last few weeks.
Yeah, and actually, some of the corporate executives at that conference were talking about things like the more androgynous look is now moving to the very gendered look of boys sections and girls sections, and how that's a very different kind of trend than it was, say, 2 years ago. And that's one way to sort of revive some of the brands. So you're definitely hearing a sort of change in tone as there is a recognition of some of this.
Also, they're moving into Americana. They're trying to make that cool again. I thought this stat from American Eagle was insane. The company chief marketing officer said they gained new shoppers in, quote, every single county in the United States. American Eagle was not that cool 6 months ago. It is very cool right now if you have a teenager or a tween in your household.
You're catching up with the Gap boss a little bit later this morning, right?
Yeah.
Richard Dixon.
Yeah, I'll ask him about that, exactly what he's seeing with that. I also am curious about how they're managing some of the uncertainty and what it would take for them to unleash some of the animal spirits. One thing that you can see in some of the data is that sales have only increased in the actual numbers because of inflation. Otherwise, they've been kind of flat. How do you turn it around? How do you get that cool factor at a time where margins potentially are really crimped?
Such an interesting moment for this sector. We'll catch up with Richard Dixon, the Gap CEO, 10:30 Eastern Time. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahira. Hey, Yahira.
Hi, John. ConocoPhillips has announced plans to cut 20 to 25% of its roughly 13,000 strong workforce. The majority of the reductions will occur this year and will include employees and contractors. According to Reuters, ConocoPhillips will hold a town hall meeting today. Meanwhile, Newsmax is suing Fox News for allegedly maintaining a monopoly for U.S. right-leaning pay TV news. Newsmax says Fox coerces distributors to unfair terms that prevent them from carrying its competitors. In response to the lawsuit, a Fox spokesperson said Newsmax cannot sue their way out of their own, quote, competitive failures. And DeepSeek is developing an AI model with more advanced features to compete with OpenAI. Sources telling us here at Bloomberg the model is designed to carry out multi-step actions on a person's behalf with minimal direction. DeepSeek's founder is pushing to unveil the model in the final quarter of this year. That's your Bloomberg Brief. John?
Want to watch there. Yahira, thank you. More from Yahira in the next hour. Up next on the program, traders hedging their bets.
Uncertainty continues to rule the day. Kind of the range of volatility on the bond side at least has consolidated much less than where we were. We're just hedging our bets.
A conversation up next with Mike Pyle of BlackRock, live from New York City. You're watching Bloomberg TV. Later on this morning, we don't usually talk about this, the ADP report. Teasing and promoting the ADP report. The estimate in our survey, 68K. That's a downshift from the previous month of 104. And investors seemingly putting additional weight on this print later this morning.
Well, if there's a little bit of a shine away from the gold standard, which is the Bureau of Labor Statistics report that comes out tomorrow, well, where are you going to turn? And that is ADP. And suddenly, they're looking pretty.
Going into that, equity futures positive by 0.2% on the S&P 500. On the Nasdaq, up by 0.3. Under surveillance this morning, traders hedging their bets.
Bond investors are a little concerned about putting on too much of a steepener trade. We're just hedging our bets. As with everything, uncertainty continues to rule the day. Kind of the range of volatility on the bond side at least has consolidated, much less than where we were a year ago, 2 years ago, 6 months ago.
So here's the latest this morning. Some investors hedging their bets on treasuries ahead of a string of labour market data this week. Mike Pyle, the deputy head of BlackRock's portfolio management group, writing the following. The loss of long-term macro anchors that have underpinned long-term asset allocation defines this new regime. Macro risk matters more now. Mike joins us now for more. Mike, good morning.
Morning.
It's good to see you. Let's go through this because I know you and the team have given this a tremendous amount of thought. What has changed? What is this new regime? And what do we need to manage now that we could ignore before?
Yeah, so I'd say, historically, what's mattered most of all, it's the growth impulse, it's the inflation impulse, it's a predictable policy framework around monetary and fiscal policy. A lot of those kind of core steady attributes of the macro environment are in historic uncertainty, and what's come in their place, well, geopolitical uncertainty, trade uncertainty, a massive technology impulse that's really defining the landscape. It means that macro matters more than ever, cannot be ignored, and at the same time, macro forecasting is a much different endeavor than it has been over the past few decades.
So what are you and the team advocating for? What are you suggesting should be the approach now versus what the approach was in the last decade or so?
Yeah, Lisa, you were just talking about the role of gold in portfolios and how important that is. I think what that highlights is investors are searching for alternative forms of diversification, and that's what we're really talking about as well. BlackRock published a piece just last week about the role of hedge funds in portfolios, and that's really about the same theme. Like, how do we identify alternative sources of diversification in this new macro environment? And I think the thesis of that piece is, there are two ways of doing it, but you can't ignore macro in either case. One, you've got to dial down the macro risk in your portfolio and really seek uncorrelated sources of return away from the macro. Or two, you need to embrace the macro and really consciously manage that. And hedge funds provide the levers to do that.
Is gold replacing treasuries as that allocation?
Well, I think that's a really great question. And like I said, I think the important thing is the theme that investors are searching for alternative forms of diversification. Some are finding it through gold. I think there are other ways as well. And like I said, we think uncorrelated hedge fund strategies, whether they're dialing down macro risk or leaning into it, that's the way of finding that kind of diversification.
Earlier in the show, John was saying that market expectations for inflation have not gotten unmoored. And that has been sort of one bedrock that a lot of people have clung to say that the Fed's independence has not yet been fully compromised. What do you make of that? Do you think that this market is overly complacent about the risk of inflation really picking up or being increasingly volatile on the heels of a Fed that is facing a much more politically difficult moment given the fiscal deficit and given the fact that more of it's going to be in the short term of the maturity profile?
So I'd say a couple things. I think one, I think there's some encouraging news in the inflation data itself. So I think, to your point, looking out over the long term, those expectations have remained well anchored. I think, I was reading some work that Jason Furman did at the end of last week and talking about the ways if you look at core PCE and look at the kind of market-based prices in that index, you see some pretty encouraging trends there. And in particular, once you strip away the tariffs, things look sort of relatively positives. I think to your point, we've heard from the Treasury Secretary, central bank independence matters. It's precious. It needs to be preserved. I think that's something that we at BlackRock believe as well. I think one of the things we would say is when you look at the risks around a rising term premium, the fiscal picture,
risks around sticky inflation, but also the need to preserve central bank credibility are all things that need to be managed if we're going to hold term premiums to a reasonable place and hold yields in that reasonable place as well.
Mike, when it comes to macro risk and geopolitical risk, you're almost a perfect individual to have insight both Wall Street and Washington. I'd love to get your sense on how you're viewing some of these trade negotiations that the administration hasn't gotten to a finish line, notably India, because you spent a ton of time there.
So, I think the administration, with respect to some of these issues, faces tough trade-offs. So on one hand, clearly, they have been looking to increase pressure on Russia. The most important way of doing that is increasing pressure on Russian energy exports. On the other hand, it's been a bipartisan priority for 25 plus years to enhance the U.S.-India relationship. And I think, balancing those two things has proven to be a challenging kind of path to navigate. I'd say what I worry about is that we're landing in a place potentially where we're not getting meaningfully more pressure on Russia, but we are seeing a deterioration of the U.S.-India relationship and a deterioration that is increasingly having impacts on U.S. firms that have pursued China plus one type strategies and now see that under pressure.
Yeah, Apple being one of them. That's for sure, who find themselves in India now with a production base with some exemptions. We've talked about this a million times. This is the problem, I think, for corporate America right now. They don't know how to price this moment. I'm not sure investors do either. You talk about tough trade-offs. Lisa touched on an important question. I just want to pin you down on it. When you talk about things like hedge funds and maybe increasing allocations to alternatives, how are you funding that? What are you telling people to do?
Yeah, so I think exactly to the point around upward pressure on term premiums. I think our view is government bonds are going to have a less important role to play in portfolios as diversifiers looking ahead. And so diversification alternatives like hedge funds, like gold, have to get a hard look from investors. But it's really that fixed income allocation that I think has got to be the point of focus.
What would you have to see when it comes to the Stephen Miron hearings or anything that would happen on the Federal Reserve that would make you say, actually, now is the time for you to have to shed U.S. Treasuries or U.S. government debt that much faster and move to these alternatives, that term premium has to go that much greater to that much greater of a degree?
So I wouldn't want to speculate on kind of future conditions. I think the fact is investors need to make decisions now. And I think our view is, there is going to be likely upward pressure on term premium from here for all the reasons I cited. That means that government bonds, whether in the U.S. or frankly elsewhere in the world globally, are going to be less effective diversifiers, and the need to navigate that risk, navigate macro risk by alternative sources of diversification is a here and now issue, not 2 years from now issue.
Mike Pyle of BlackRock. Really thoughtful stuff. Appreciate your time, buddy. It's good to see you.
Good to see you.
Thank you. Talking about a new risk, a different regime, and for that reason, you need a different diversifier. And bonds don't get it done anymore. And we can talk about the political consequences over time, but certainly you're seeing them right now in Europe and elsewhere.
If you put this equation together, it's that people don't want to invest in government bonds in quite the same way, and they're taking money out. So that 1% withdrawal that Goldman Sachs was talking about from, say, publicly owned U.S. government debts might be happening in a very real sense. It might not all be going to gold. It might be going to other asset classes. But this is something clearly a lot of investors are thinking about.
There's an obvious feedback loop here from policymakers, a more hectic environment into the markets, and for the markets back out again. You've got to make some tough decisions if you're a fiscal authority at the moment on how you're going to counter that if people don't want to buy your bonds for those reasons.
Yeah, are they going to make those hard decisions, though? Because people don't want them. They want their money. They want their benefits. And that's part of the problem that we see around the world.
Up next on the programme, in the second hour of Bloomberg Surveillance, we'll catch up with Barbara Doran of BDA Capital, Monica Guerra of Morgan Stanley, Jed Dorsheimer of William Blair, and the former New York Fed President, Bill Dudley. From New York, this is Bloomberg.
This is not a bond market which is not functioning. It's a bond market that's repricing.
I'm not overly concerned on this run-up in yield.
The distribution of rate outcomes is much greater to the downside than what the market is currently pricing.
We have seen fiscal concerns pretty much across the board.
That all reinforces at least a steepening bias.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores look like this. Snap at a two-day slide in yesterday's session, adding some weight to the rally this morning, up by 0.2% on the S&P 500. On the Nasdaq, up by 0.24. In the bond market, some stability thanks to some weaker economic data. The 10-year, sub 420, twos below 360, and 30s backing away from 5%. 487 this morning. The data slate is stacking up as follows for this morning. Later on, 8:15, ADP, 8:30, jobless claims, all building up to tomorrow and a payrolls report.
And there's a real question here about what it shows for the economy at a time when people are looking at this for a Fed reaction function to how much they're going to cut rates, right? It has to kind of thread the needle. Be weak, but not too weak. Be something that shows a softening, but not soft. And something that could give some impetus to Fed Chair Powell to cut rates in a significant way at the same time that we're seeing a lot of noise down in Washington, D.C. about who the future could be at the Federal Reserve.
A little bit of noise. Turn up the volume later on this morning. Stephen Myron down on Capitol Hill facing a grilling as he looks to get a seat in the FOMC. Put it this way, right now there is a credible argument to reduce interest rates at the Federal Reserve. Whether you agree or disagree, there is a credible case to make. Could Stephen Myron make that case at 10 a.m. Eastern Time?
He's certainly going to try. I think a better question going into the hearing today is anyone going to ask? Well, Republicans are going to ask, but Democrats aren't. They're going to use this hearing as a referendum on Fed independence and really try to get Stephen Myron to potentially go against maybe even what the President of the United States has said when it comes to Fed independence. But his confirmation is in no way in doubt. The issue I think that the White House is facing is can they get him in the chair before September 16th? That is going to be incredibly challenging.
I'm going to say something and I'm going to hear you both groan, okay? But when we talk about Fed independence, what does independence mean? Okay, I know that's the ultimate sort of Lisa thing to say. However, ultimately, that is a real question at a time where the U.S. deficit is increasing dramatically. And this Treasury Department is going to issue an increasing amount of it at the front end of the yield curve. In other words, short-term rates, which is what the Fed has some control over. So you can imagine that regardless of who is the president going forward, just by virtue of this profile, you have a more highly politicized Federal Reserve. And this really is the crux of the question that the markets are grappling with. What does that mean for inflation and for some of the changing metrics, the targets for the central bank?
I don't think anything you're saying is controversial whatsoever, so no groans from me.
Yay.
Going into next year, I think we have to shed the traditional way of looking at the central bank and get away from the Chairman Powell world and start thinking about the future and how this institution will be managed. And not just interest rates, but also the balance sheet. It's got to be something we give more thought to in the coming months.
And I think the market's trying to give this thought. And right now, long-term bonds are flirting with this idea of a regime change, but not necessarily buying into it because you still are seeing inflation expectations moored and you aren't seeing runaway yields. But that is the ultimate check. How does the market respond to what this looks like in the coming year?
This morning, we're down 2 basis points, 30s at 4.88. Coming up this hour, we'll catch up with Barbara Doran of BDA Capital as tech stocks rally ahead of jobs data throughout this week. Monica Guerra of Morgan Stanley as President Trump takes his tariff fight to the Supreme Court. And former New York Fed President Bill Dudley as Trump's Fed pick faces a confirmation hearing. We begin this hour with stock steady as investors await key job market data. Barbara Doran of BDA Capital writing job numbers will likely be on the low side and the JOLTS numbers indicate a continuing gradual cooling in the labour market. Barbara joins us now for more. Barbara, good morning.
Hey, good morning.
It's good to see you. Last time we caught up with you about a month ago, you talked about a market ripe for a pullback. Now, the data has pulled back, the market hasn't. How do those two things stack up?
Yeah, well, I think what's happened in the meantime is the Fed Jackson Hole, where for the first time, Powell really gave a very different message, which is that instead of just watching both inflation and jobs in terms of equality of interest there, it's now more concerned about jobs. And that was because the revised data, as we know, averaged 35,000 jobs a month for the 3 months, May, June, July. And so that was a significant difference. And I think that's, it raises a big red flag, for the Fed to think, hey, maybe we really have to focus more on that right now. Inflation, still expect the tariff impacts to feed through. That's been a lot slower than people expected. But it looks like now the job concerns are a little bit more ascendant in their concerns than inflation data.
So would you push back against the cyclical tilt that emerged through August into September?
I would a little bit, because the concerns, what we're seeing, and of course we have jobless claims this morning, which I'd be surprised if they were anything less than stable, because that's been what's been happening. And tomorrow, of course, the non-farm payroll report, which I think estimates are 75,000. And again, it'd be hard to see that being even higher. So we will see what happens there. But, I think it's going to be steady state.
At this point, how can you bet against a market, though, that's being driven up by something completely independent from the economy, which is artificial intelligence and all the promised efficiency gains and cost benefits that companies are touting?
Well, I think that's an important part of it because that ties into the earnings story, which, of course, is what drives stocks. And if you saw the second quarter, expectations had been dramatically lowered after the first quarter, which was some 13%. And it was coming in at expectations of just under 5%. Well, it came in at about 12%. And if you look at the consensus estimates for next year, fiscal in the calendar year 26, you're looking at 14% earnings growth. And that is still what's going to drive, and a big part of that is the AI play. But of course, it's been the expectation that in 2 weeks, the Fed will cut rates. And I think the probability, the CME is now at 97+% that the Fed will cut rates. And certainly if you look to October, it's only about 50% there'll be another 25 bips cut. So it looks like interest rate cuts are coming.
Okay, so this is the reason why there is this feeling on Wall Street that it's a good time to be bullish, because ultimately the Fed's going to have your back one way or another. And it seems like there is a new bias on the Federal Reserve to run the economy just a touch hot in order to preserve jobs and sort of keep things stable, even at the expense potentially of inflation going higher. How much are you incorporating that sort of shift in bias into your investing view?
Well, it's a good question because you've seen the rotation until yesterday, the typical rotation out of the big mega cap tech stocks, which are always going to be vulnerable to profit taking when you feel that you want to invest in other areas. And so I think that's people are looking. You've seen the small caps have a big run. In fact, in August, you had the biggest outperformance differential between the NASDAQ 100, which was, I think, about 1.3% versus 7+% for small cap. Now, I personally see that as a trade. I don't think that's sustainable because, again, there is uncertainty about the economy. Job market is slowing. We haven't seen the layoffs yet, so people are still employed. You still got decent wage growth, and you still have some 40-50 trillion has been created since 19 in household wealth. So people are wealthy. Not to say that lower income is not being stressed because of the tariffs, the regressive tax impact.
What would need to happen for you to take that thought that this is a trade and actually something more sustainable?
Well, I think we'd have to see the economy holding up. I think the Fed would have to cut rates. We've got a number of data points coming up, whether it's the CPI, PPI, jobs reports. And if we maintain, a level of jobs in the economy, you see how the GDP growth this year probably will average 1.5%. That's not huge. It's okay. It's sustainable. But it doesn't indicate an economy that's going to take off and benefit cyclicals and small cap.
When you look at the data coming up, didn't Chairman Powell just give the market a green light to look through inflation data?
Looks like it. But they're also being very careful. And I think there's still, and certainly my view, is that we just really got the final tariffs. Well, we'll see what happens with India and some others, but in August. So there's a lot of tariff impacts that have not fed through. And we know that there's big inventory building, and companies, without knowing what the impacts are going to be, pushed it back on their supply chains. They took some of the hit, but they're going to, now that they have some clarity, they're going to start to figure out, we got to push, we got to raise prices. That will happen. But it's taking longer than everybody expected because there's been such uncertainty on the policy level. So Fed is still very aware of that. And you certainly hear this from Fed commentary. Around the street, some are saying we still don't need to cut rates. So we'll see.
Stuart Kaiser of Citi was on the programme a little bit earlier, and Stuart's making the case for a sneaky bull case. And a sneaky bull case in his eyes is ultimately that we get this reacceleration. We get growth starting to inflect higher as we turn the year, go into year end and come out the other side. What I hear from you, though, is that that's not the sneaky bull case. Actually, that's the base case, and that's what we're priced for, a reacceleration in growth. Is that fair?
Actually, I think that is fair because, again, it's all about earnings. And when you saw it, a lot of companies raised their guidance. And it wasn't just because they had cut guidance, in the uncertain time period in April. But it's really looking ahead. And, of course, companies are very cautious, in looking ahead in terms of their guidance. So you're seeing, pretty rosy picture. And, again, anything could happen. You could start to see more layoffs. But it's been such a gradual cooling. And, of course, we have to see the impact. They're really stepping up the deportation. That is going to have an impact on the lower level jobs. If they, at this current rate of 3,000 a day, and it looks like they want to hire more ICE officers, that's probably in a year 1 million workers taken out of the system. And we'll see what impact that has.
So if you're cautious, what are you buying and what are you selling? Are you selling stocks and buying bonds, or does that no longer work?
I am not buying bonds, and I continue to sell on a risk management viewpoint, whereas things like NVIDIA or we're going to have Broadcom after the close today, and trim profits there. I think there's been, some international has been an outperformer, and I think that can continue for various reasons depending on the market, but that's also, it's a fiscal thing. It's also what's happening in terms of their economies. So I think you can start to go in that direction, and I think you continue to look at different AI plays that are developing and will continue to develop.
I think that's a pretty interesting response. Bottom line, you're expecting growth to disappoint, but ultimately you're not buying bonds. Now, what is it about bonds right now that don't provide that diversifying characteristics that typically they would provide in a disappointing slowdown?
Well, I think it also depends on, I really think stocks are the way you create wealth, and bonds are really a placeholder. And bonds, even with, if you go out on the curve or do high yield, you're still not making a lot past inflation, And so you had a guest on earlier talking about non-correlated assets.
Yep.
And that's a different direction one can go, where you can get higher returns than bonds, and they will be not correlated. But bonds, you saw the freight that happened earlier this week, and we saw this back in April, where suddenly, because of the tariffs, that may be rolled back, okay, what happens to the fiscal deficit? And so the bonds freak out, the long end, but then they settle down because it's sort of out there in the future. And the market really responds to what's immediate and foreseeable in the next, say, 12 to 18 months. So I think we will periodically have these rates, concerned about fiscal, our fiscal situation. But again, that fades, and also because we're in a unique place in the world in terms of our, the U.S. dollar. We are the reserve currency.
Yep.
So.
Barbara, it's good to see you. Thanks for dropping by. Barbara Doran there of BD8 Capital. This morning, bonds are doing better. Yields are lower across the curve by 1 or 2 basis points. 30s down to 488, 2s at 360. With an update on stories worldwide with your Bloomberg brief, let's cross over to Yahara for more. Hey, Yahara.
Hi, John. You all mentioned this one earlier. American Eagle shares are soaring 26% in the pre-market after the retailer reported higher than expected quarterly sales, boosted by demand from its Sydney Sweeney ad campaign. The company's chief marketing officer said that in just 6 weeks, the campaign has generated unprecedented new customer acquisition, with, as Annmarie said, new shoppers gained in every single county in the U.S. Meanwhile, the effort to ban individual stock trading by lawmakers is gaining momentum. A bipartisan group in the House introduced a bill that would ban members of Congress from owning and trading individual stocks. The bipartisan legislation comes on the heels of a similar measure which advanced in the Senate and is awaiting a floor vote. And the Metropolitan Opera has reached a deal with Saudi Arabia that will have the company perform in the kingdom for 3 weeks each winter. The agreement, which is expected to bring the Met more than $100 million, is expected to cover a large portion of its financial needs through at least 2032. The Met hopes this will help it amid a period of acute financial stress. That's your Bloomberg Brief. John?
They can stop calling me now. Always get phone calls from them.
You get calls from the Met?
For donations.
Really?
All the time.
How often do you go to the opera?
I screen those calls now.
Oh, yeah, is that right?
In October. You should come with me, John.
What are you watching?
Andrea Bocelli is coming to town.
Okay, that sounds quite cool. To be fair. All right.
So they're going to keep calling, basically.
They're going to keep calling, basically.
Call him now. He's interested.
Green light.
That's what happens. All right, let's move on. Up next, Trump's tariff agenda on the line.
We have a very, very big case in the Supreme Court. If we don't win that case, our country is going to suffer so greatly. I think it's one of the most important cases I've ever seen go before the Supreme Court.
Up next, we'll catch up with Monica Guerra of Morgan Stanley from New York City this morning. Good morning. Live from New York City this morning. Good morning. Here's your day ahead. It's stacking up as follows. Tons of economic data later this morning, 8:30 Eastern Time, jobless claims. Before that, typically we don't make a big deal of ADP, but given what's been happening with payrolls, more and more people making a bigger deal of ADP. That drops at 8:15 Eastern Time. Then later on, at the same time, we get the ISM, which is worthy of a few looks. We also get this one. Box office on Capitol Hill. Stephen Myron and his confirmation hearing in the nation's capital.
So expect a lot of questions about his idea of Fed independence, especially given that paper that he co-authored last year, talking about how maybe the way to give the Fed a greater degree of credibility is to give the president more authority to fire at will a number of the members. There are a lot of questions here. Key question for me is, how does the market respond? How much is the market paying attention to this? And that, to me, is the reaction function that might have the greatest meaning, not only for the market, but also for Congress.
And unlike the economics profession right now, this market's not losing its mind. Some people might say it's being complacent, but ultimately it's not losing its mind.
In part because they believe in that check, right? That ultimate check of the market, but also because you're not seeing inflation expectations become unmoored. And in fact, a lot of the inflation data, as we've been talking about, have been coming in better than expected.
Equity futures this morning doing better than expected, again up by 0.2%. The bounce back continues on the Nasdaq 100, higher by 0.3 in the bond market. Bonds are doing okay. We're stable here. Yields are down by 2 basis points on 10s to about 420. Under surveillance this morning, the president's tariff agenda on the line.
We have a very, very big case in the Supreme Court. If we don't win that case, our country is going to suffer so greatly. I think we're going to have a big victory. These deals are all done. I guess we'd have to unwind them. And I used them wisely, and people respect America again, and we've become a rich country again. The money coming in is incredible. I think it's one of the most important cases I've ever seen go before the Supreme Court.
So here's the latest this morning. The president calling on the Supreme Court to uphold his global tariffs. The president seeking a highly expedited schedule for the high-stakes case. Joining us now from Washington is Bloomberg's Tyler Kendall. Hey, Tyler.
Yeah, hey, John. So the White House is asking the Supreme Court to hear arguments starting in early November. That would open the door for a decision by the end of the year, though worth pointing out that the court's term goes until the middle of 2026, so that's by no means a sure thing. But the White House is certainly pushing its case, saying that it's actually complicating ongoing trade negotiations. And we know that trillions of dollars are tied up in the decision. Now, I mentioned this earlier this week on the program, but I was pretty struck by the Committee for a Responsible Federal Budget, which is projecting that 71% of anticipated tariff revenue would vanish if the Supreme Court ultimately upholds this decision. And our own analysts at Bloomberg Economics are estimating that the average U.S. tariff rate would be cut by more than half. Now, at issue here is that this appeal covers 2 instances where President Trump invoked IEEPA, the International Emergency Economic Powers Act, to declare national emergencies and then impose tariffs. The first, the so-called reciprocal tariffs, where he cited persistent global trade imbalances, and the second, the tariffs against Mexico, Canada, and partly on China, where he cited concerns when it comes to the border and fentanyl. So the 2 big questions that the court really needs to decide here is, 1, does he have the authority under IEEPA to impose tariffs? Because we've never seen this done before. And 2, did he invoke IEEPA correctly here? Did these national emergencies rise to the legal standard of being what's known as an unusual and extraordinary threat? All of this to say, John, this is going to be very consequential, but we do know that the White House is preparing other ways to use tariffs. A person familiar tells us that the administration right now is preparing other federal authorities that could invoke the levies depending on how this court case goes, even as they are optimistic about their appeal in front of the Supreme Court.
Tyler Kendall with the latest in Washington. Tyler, thank you. Moved the goalpost a little bit here, haven't we? It was about bringing production home. And now it seems almost exclusively that this is about raising money.
Well, that's the one that's more popular with markets, especially given the fact that the CBO is estimating $3.3 trillion of revenue over the next 10 years if these tariffs stay on at this level. There is a question of how much production it moves back to the U.S., how much that factors into the court case. And I actually am curious where the emphasis lies to give clues as to what tools they will use going forward.
Joining us now is Monica Guerra of Morgan Stanley to discuss some of this. Just how much deficit risk is in play with this court decision?
A significant amount. The OBVA added, $4.5 trillion to the deficit in the last, estimate that they gave when they modeled things out. When we're thinking about this revenue, we're looking at about, $20 billion plus a month. That's a huge shift. It was $5 billion prior monthly. So again, there's a lot at risk here when you're looking at that $2 to $3 trillion range of revenue that they're expecting. That's enough to really offset a lot of those budget hawk concerns, right? Especially around the deficit.
And this is one reason why markets haven't freaked out at some of the budget deficit concerns. There is a question of why there hasn't been more of a response in the long end of the yield curve to this court ruling. And some people argue, well, that revenue will keep coming in regardless, one way or another. Do you agree with that?
Yeah, so it's our base case that even if the Supreme Court does rule against Trump, that, if there's a will, there's a way. And we've seen that not just through them exploring other options of levying tariffs through different federal agencies, but also through different, sections of tariff law, Section 232, Section 301. There's a ton. There's a whole list. We recently published a report where we really get into the details on each one, the timeframes, how it works. And while some are limited, they can layer these, and there are some that are more long-term. So there are options out there, and I think that markets understand that and that they're trying to look through any volatility around the Supreme Court.
The direction of travel is clear. They're going to find a way to increase tariffs, even if the Supreme Court does strike this down. But do you think the Supreme Court, is that your base case? Will they uphold IEEPA or will they strike it down?
I'm not the expert on the Supreme Court, but what I can say is I think that there is a strong likelihood that they will rule in favor of the president. And then if not, right, it's just how do we get there? And we also have to remember that right now the tariffs are still in place. So it's not like they've completely rolled off. We're still collecting revenues, right, as we go along. And even if we do end up with a patchwork and say you get 10 billion a month, that's still double what we were receiving before, and that is a help towards that deficit.
How messy is that unwind going to be, though, if they were going to have to potentially give back some of those funds?
It would be messy. If you're thinking about even negotiations with the EU, they're trying to proceed as business as usual, but they're being very cognizant that some of these things may have to be unwound if things are unstable. Now, what's interesting is that when other foreign entities have been asked in the recent days, how are you approaching this? They're still continuing negotiations as if things are in play. And so we have to, keep that in mind, that there's a strong belief that tariffs are coming one way or the other.
So this sounds very technical, but I have been getting a little bit overly technical recently. The stay from the court only goes till October 14th to keep these tariffs on. The Supreme Court has to decide to take this up and then rule on it, and that stay expires. What happens then? I mean, can't companies go to the government and say, can you give me my money back because I paid you a couple $2 billion?
It's unclear to me if that's retroactive, right? So if you're already paying, I'm not sure about the logistics there. I doubt it is. I'm sure the money that the government has collected will stay in the Treasury where it's safe and sound. I would say the biggest concern for us from a markets lens, right, is that if there's more volatility here, especially for businesses come October, are people going to hold cash on the sidelines? Are they going to continue to wait on, say, CapEx expenditures? What is the longer term economic impact, right, from that volatility, especially if they're waiting October to November to get that decision?
It has the potential to impact pricing strategies of corporations as well. If you think they're sitting on their hands waiting to find out what happens here, they're not going to pass it on to the consumer just yet. Most people believe that's what's been happening over the last 2-3 months or so. They're going to have to wait even longer. Can you imagine sitting there in the C-suite right now, trying to come up with the appropriate price to put on a product? You've got to believe that the tariffs are going to stay before you really think about passing that on.
This is a reason why people expect that sort of sneaky bull case to be that reinvestment cycle. How at risk is that? Should there be some sort of, prolonging of this uncertainty?
Well, to your point, Lisa, the Supreme Court, there ends the next term, June 2026. That could potentially be when we get a final decision. And this is why the Treasury Secretary had this declaration, part of the submission yesterday, saying that would be the unwinding of this would be maybe $1 trillion in tariffs that have already been collected. And he says this could be significant disruption.
It's amazing how much the bias has shifted in financial markets, seeing these tariffs as bond bullish, bond positive, when back in April it was very, very bond negative.
Right now, people have no clue what the long-term impact is. They're looking at the short term. The short term is money's coming in, and that looks nice. And that's basically what Wall Street's betting on.
Monica, this was nice. It's good to see you, as always. Thanks for being here. Monica Guerra there of Morgan Stanley. Up next on the programme, Jed Dorsheimer of William Blair on AI's impact on the US power grid. Plus, we'll touch base with Danny with your morning movers as Goldman Sachs looks to invest as much as $1 billion in T. Rowe Price. That stock is up 7%. Stock still just about positive, up 0.1% on the S&P 500. On the Nasdaq, up by 0.2. Yesterday's bounce supported by Apple, supported by Alphabet. equities are doing okay. In the bond market, the bond market's doing okay as well. Check out the 30-year and just think about the range we had yesterday. We did a basis point of 5% on 30s in yesterday's session at the highs. At the lows, 488. This morning, 487.45 and down 2 basis points on the session. Bailed out in many ways by weaker than expected economic data. And Lisa, I've got to say, there was a lot of it. It wasn't just job openings. The beige book, which you teased and promoted yesterday, turned out to be dreadful. And if that's the Fed's read on what's happening in this economy right now, no wonder they're pivoting to rate cuts.
Because you ultimately see stagflationary types of dynamics. You saw almost no districts of that the Fed surveyed showing growth. There was essentially a stagnation at the same time that companies are raising prices. You're seeing this in the JOLTS data with job openings coming down to the lowest levels in about a year. You put this all together and you think about maybe bad news is bad news longer term, which will give a bid to bonds and maybe cap how high inflation can get.
Later this morning, more data. 45 minutes away, ADP. 15 minutes later, jobless claims. And then at 10 a.m., don't forget, ISM services, worthy of a look as well. That's the latest with the economic data. 2 hours away from the cash open with your morning movers. Here's Danny. Hey, Danny.
Hey, John, some breaking news in the last 30 minutes or so, and that is Goldman Sachs will be buying a $1 billion stake of T. Rowe Price. Buying those shares means that it will become its biggest shareholder. All of this part of a new partnership between the two of them to make more products, be it for public markets or private markets, really trying to gear towards the retail audience, something that Goldman Sachs Asset Management has been trying to get into beyond their wealth offering. So those shares up 7.7%. Elsewhere on the move this morning, we are looking at Snowflake shares falling more than 1.5%, announcing that its CFO, Mike Scarpelli, will be retiring effective September 22nd. Probably something he would like to see his shares falling on that retirement announcement. Probably not great for his replacement, Brian Robbins, who will succeed him. He is coming from GitHub, where he is currently serving as the CFO and has been since 2020. Finally, John's favorite story this morning, and that is American Eagle. Really strong sales numbers. And they specifically said it was because of the Sydney Sweeney campaign, saying that her signature jeans sold out everywhere, that they gained more customers in every single county of the U.S. The CEO saying that the momentum is national and it is real. So, John, those shares up just under 27%.
Danny, thanks for the update. Appreciate it. Look, my take on things, and this doesn't apply to every single company on the planet, but for most, I believe, they don't have values, they care about sales. And if you're seeing American Eagle have success with what was a quite polarizing strategy from them, I wonder how many other retailers are going to lean into the same thing in the quarters to come.
You're already seeing it in some degree in terms of the advertisements and how much they're talking about made in America, and they're talking about what it is to be attractive to the opposite sex and things of that nature that were diminished, I think, in previous years.
Well, Abercrombie and Fitch is trying to lean into this, and they're doing this whole tie-up with NFL. Brittany Mahomes, a friend of Travis Kelce, is going to be wearing more Abercrombie and Fitch. So I think they're all trying to find their own way to lean into this Americana aesthetic.
Which makes the Cracker Barrel decision even more ridiculous. If you can see this is where the country is trending, leaning into heritage Americana, you can see that polarizing decisions like this one turn out to be beneficial to the bottom line and the top line of the company. What on earth were they doing over at that company?
Well, if you're a conspiracy theorist, you might think they did this purposely to actually get their name out in the press. What did Cracker Barrel get at the end of this? A phone call from the deputy chief of staff of the White House. I could see a moment where you see the president on the road and he stops into a Cracker Barrel and he said he's making it great again.
American Eagle up by 27%. Wanted to talk about the data just briefly. This coming in. Hiring intentions. Challenger job cuts. Lisa, this data is not good. Not good at all.
And when you look deeper into this data from Challenger, Gray, and Christmas, it shows that hiring plans among the companies they surveyed fell to the weakest level for any August on record. This highlights the sort of churn dynamic where maybe companies are not laying off a great number of workers. They are increasing layoffs, but they're not hiring. We're seeing this also with on the margins firing. Yesterday, ConocoPhillips planning to cut 25% of jobs from their staff. You put this together, that's the churn dynamic that's given some people some agita.
One more data point on the labour market, one more data point that doesn't look great. On our radar this morning, let's whip through some stories for you. President Donald Trump taking his global tariff fight to the Supreme Court. The administration asking the High Court to take up the case by September 10th and to put it on an expedited schedule, with arguments expected in early November. Elsewhere, President Trump's pick for Federal Reserve Governor facing a Senate confirmation hearing today. Stephen Miron saying he will preserve the independence of the central bank as the president vows to gain a majority authority on the Fed. And finally, tech industry leaders attending an AI event at the White House today. The First Lady, Melania Trump, hosting CEOs from Meta, Apple, Microsoft, Google and more. The event will be followed by a reception with President Trump in the Rose Garden.
With a real discussion around how to expedite some of the use of AI in businesses, in schools in particular. This is a big issue. I was really struck by the pavers they put over the Rose Garden. They took away the grass. I just was really struck by that.
I have a lot to say about this.
But it really, to me, highlights how they want to make these the national champions at a time where there's this real tension, especially after the Google case and this question about what they could do with antitrust or not. How do you make national champions while also clamping down on things that are a bipartisan issue?
Two things, notably one individual missing that you would have in an event like this, Elon Musk. He is clearly still very far from the president, have fallen from the graces of the president. Two, the Rose Garden. Those umbrellas. The president must be missing Mar-a-Lago. And you heard a White House official say the Rose Garden Club is the hottest thing in town. Those, put up the pictures. Those umbrellas, those yellow umbrellas are, I don't know if you've been to Mar-a-Lago. They literally look like the patio in Mar-a-Lago. When I was there last week, waiting to go into the cabinet room, the president was actually also showcasing and playing his playlist. The same playlist when he DJs at Mar-a-Lago, he's now doing in the Rose Garden. You can hear it every single day.
Is that the rant?
That's the rant, yeah.
There's the
it's
rant.
a little weird,
And
no?
that's the umbrellas. I'm with you, I'm following it. Are you saying this is going to be a membership scheme in years to come?
It literally sounds like this is his new club and he's having his first party, it sounds like today with, the tech world.
Save the grass. I mean,
are you on the grass back?
I just,
Wasn't this about high heels and being able to walk?
The president said it's a big issue for the ladies with their heels, which I do actually have.
Wear sneakers.
Well, it's hard to wear sneakers because then if you're in a suit, your pants are hemmed. I do feel for the ladies that have to wear their heels in the grass. I've been one of them. But at the same time, now it's just all this pavement and it's a little weird.
The important stuff right here on Bloomberg Surveillance. Let's turn to the AI race. Barclays predicting Wall Street could see a $100 billion plus M&A deal in the sector by this time next year. Jed Dorsheimer, the group head of energy and power technologies for William Blair, writing the following. Demand for data center growth has been building for the past 20 years. Until recently, this demand was manageable. Jed joins us now for more. Jed, welcome to the programme, sir. Let's spend some time on this. What is making it increasingly less manageable? What makes it unmanageable right now?
Well, I think it's just I think we have been lulled into this complacency of maintenance for the past 50 years, where we've, gotten used to, 0.5 to 1% type growth in terms of capacity. And now all of a sudden you're seeing this surge driven by the race to build these data centers and the CapEx spend. And quite frankly, the grid, which used to, how we built that grid out, which used to be around firm baseload, a lot of the variability that's been brought on by renewables is just making this incompatible. And that's what, that's the friction that we're seeing in the within our power sector.
Jed, could you just illustrate to us, just spell out for us directly, just how great demand for electricity has been, and a point that I know you want to make, just how unevenly that demand is dispersed across this country?
Sure. I mean, listen, if you want to, the nexus for data centers is in Virginia, but what you are seeing is states where you have cheap or therefore firm baseload, where you're seeing it's not an even disbursement in terms of who's benefiting from the CapEx. So it tends to be south and southeast, as well as some of the mountain states such as Idaho, Wyoming. And, I think that, so it's never been an even spread, but I think that, both of the coasts have largely been a beneficiary, and now you're seeing a pretty dramatic change with respect to where people are building out. And that is, those decisions for these data centers are being built around where you have access to energy locally.
Jed, how do you map out a long-term plan that backstops some sort of big infrastructure project at a time when technology is changing pretty significantly and quickly? The news overnight was that DeepSeek over in China is preparing an AI agent that can compete with OpenAI. And it just goes to this idea that maybe eventually a lot of the artificial intelligence can be done more cheaply, more efficiently, without as much energy. How does that factor into some of the models that people have for projects that span out decades ahead?
So it's a great question. It's one that I'm receiving all the time. That's probably, but I want to point out, you said, cheaply, efficiently, with less energy. Those three don't match up. And so there's this concept known as Jevons paradox by economist William Jevons back in 1865, who was asked to look into the efficiency of coal. And this is held up throughout time. So technology is deflationary. So technology will drive down costs. But as the social utility for that technology increases, the use model always goes up. And so I'll give you an example. When I grew up, my parents' car got maybe 5 miles, 7 miles per gallon. Today, the typical automobile, non-hybrid or electric, is getting 35 miles per gallon. What happened was people bought, my parents now have 2 cars, and they might, they drive more. And so and I think the same is going to happen with AI, that as the technology becomes cheaper, the use will go up. Therefore, the energy that's needed to provide, even if you get to models and agents that are more efficient, it's only going to proliferate. And that's going to require more energy.
When it comes to energy, what kind of sources are you talking about, Jed?
Well, I think the primary beneficiary is going to be natural gas and going to be nuclear. And the reason being is what we're starting to see is the real economics behind variability. So while solar and wind sound great, it's wreaking havoc on the grid. And there's really, you can solve some of that with batteries, but it certainly pushes up the cost of that. So the conclusion that we've come to, and we did a statistically significant study with 531. It was a meta-analysis with 531 different data sets. And what we found was that as you get over 10% on a grid, and the U.S. is split up into 7 different grids, as you get over 10% penetration of variable assets, that the variability actually usurps the asset cost. What does that mean? It means that there's no benefit. It only pushes up prices. And people are already feeling that squeeze. I've got this saying, pain at the plug. And I think that's going to be a meme that becomes more popular, because we usually talk about it at the pump in terms of oil prices, et cetera. And I think the squeeze is going to be on the electricity bills from all of this.
Jed, it's already happening, and I couldn't agree with you more. I think by the midterms next year, this is going to become a really big political issue. Jed, appreciate your time, sir. Let's do it again soon. Jed Dorsheimer there of William Blair. That's going to be potentially one of the #1 issues alongside housing affordability in the next 12 months.
It's already been an issue in Washington. You see a number of members of Congress concerned because their constituents are saying my electricity bill is coming up, and guess what? You have these AI companies, tech companies coming in and just having this massive demand when it comes to wanting to power all their technology and all the energy that's going to be needed for this. What Jed's point was the fact that you're going to need natural gas, you're going to need nuclear, you're going to need every single source of power to be able to do this.
We've got lots of economic data coming up this morning in about 30 minutes' time, the ADP report after that jobless claims. Before we get there, let's get you an update on stories worldwide with your Bloomberg brief. Here's Yahira. Hey, Yahira.
Hi, John. Harvard University scoring a major legal victory in its battle with the Trump administration. A court ruled that the U.S. illegally froze more than $2 billion in research funding. Judge Allison Burroughs said the administration violated Harvard's free speech protections, as well as U.S. civil rights and administrative laws. Meanwhile, the New York Giants have agreed to sell a minority stake in their storied franchise to Julia Koch and members of the billionaire Koch family. The deal is for 10% of the franchise at a record valuation of $10 billion, according to Sportico. A sale cannot be finalized until it is presented to other NFL owners at a meeting in October. And speaking of sports and deals, Bloomberg hosting its annual Power Players event today in New York City, set against the backdrop of the U.S. Open. Bloomberg Power Players brings together influential voices like the ones behind me from the business of sports to identify the next wave of disruption that could hit this multi-trillion-dollar global industry. Check out all the coverage on the terminal on LiveGo. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira in about 30 minutes. Up next on the programme, confirming Stephen Myron.
He would like to see Stephen, who I've known for a long time, get on there as soon as possible. By putting Stephen Myron in, that gives us more time.
In just a second, we'll catch up with the former New York Fed President Bill Dudley from New York City. This is Bloomberg. Stocks are positive, just about up by 0.1% on the S&P, up by 0.2% on the Nasdaq 100. Bonds are stable, 2-year, 10-year, 30-year, twos at the front end of the curve, near the lows of the year at 360. At the long end of the curve in yesterday's session, backing away from 5% off the back of weaker than expected jobs data, job openings lower. Also a pretty disappointing negative read on the economy in the beige book. Then this morning, Bramo, challenger job cuts. Now, I know typically we don't make a big deal of this, but it just reinforces the current view, which is this labour market has slowed down.
And frankly, hiring plans just are not there. We're already seeing that with the excuse of artificial intelligence, but it's a convenient excuse at a time where you're trying to plug gaps to not necessarily hire anybody new. Everyone who I talk to among the retail CEOs are making their money by cutting costs. How are they cutting costs? On the margins, attrition, not necessarily hiring as much, and you're seeing this across the board.
More jobs data about 30 minutes away, 25 minutes away, the ADP report just around the corner. And the surveillance in Washington, D.C. confirming Stephen Myron.
The president has great sway with Leader Thune. Leader Thune's been a great partner during the tax deal, and I think that he would like to see Stephen, who I've known for a long time, get on there as soon as possible. By putting Stephen Myron in, that gives us more time. And again, I want to cast a wide net. The president's very open-minded.
So here's the latest this morning. President Donald Trump's Fed governor nominee, Stephen Myron, emphasizing his commitment to Fed independence, writing in his opening remarks, "My opinions and decisions will be based on my analysis of the macroeconomy and what's best for its long-term stewardship." The former New York Fed President Bill Dudley joins us now for more. Bill, welcome back to the program, sir. I imagine you'll be tuned in later on this morning when that hearing begins. Bill, what would you like to hear?
Well, I think that he's already foreshadowed what he's going to say. The Senate is worried about compromising the Fed's independence, and that's probably the only thing that could hang up this confirmation hearing. And he's already stated in his opening remarks that he's going to honor that. Obviously, what that means in practice once you're in the Federal Reserve remains to be seen. But he's going to say the right things, and I expect him to get confirmed.
Bill, I imagine that you're very focused on Fed independence, and I understand why. But when you look at financial markets, we haven't seen a major de-anchoring of inflation expectations. This hasn't showed up in a dramatic fashion. Do you see anything to be concerned about?
Well, I think that what President Trump is trying to do is unprecedented, trying to fire a sitting Federal Reserve governor. Whether that ultimately leads to majority control of the Board of Governors, and then what does the Board of Governors do with that majority control? People have speculated that they could make decisions about the renewal of the Federal Reserve Bank president's terms when they come up in February of next year. But I think, we don't really know where this is going to go. I think the effort, though, is unprecedented. So I think you have to take it seriously. I think at this point, markets are still pretty comfortable about this. I think probably a little too comfortable given the fact that the president is trying so hard to influence monetary policy. But how this plays out, there's a long way to go.
Bill, though, when it comes to what's going on in terms of potentially having the reinstatement of the regional presidents, that would mean that Governors Waller and Bowman would need to sign up for that. You know these individuals. Do you think that's something they'd be interested in doing?
Well, I think I think you got it exactly right. You could have 4 people that were Trump appointees on the board of governors, but not all 4 might not agree to go so far as start to really change the composition of the Federal Open Market Committee by not reappointing presidents. So I think and I think that's one reason why people are pretty optimistic that this worst case scenario in terms of Fed independence is not going to happen. That said, we're already seeing actions that are unprecedented, and that's not the only thing that the president potentially could do to undercut Fed independence. So the very efforts that he's making, I think one has to take it seriously because the process in the game isn't over yet.
Well, when you look at this unprecedented action, I think you're talking about what's going on with Governor Lisa Cook. But what happens if she is charged basically with mortgage fraud? Wouldn't that be for cause for the president to say she doesn't have the trust in the public?
Well, I think there's 2 issues here. The first issue is what does for cause mean in terms of can you dismiss someone for cause unrelated to their actual performance on the job? Most people have interpreted for cause meaning negligence and gross incompetence, malfeasance in the execution of your job. The second issue, though, with Lisa Cook's issue is if she were to be found guilty, the question is even if the president doesn't have the authority to remove her, is it really tenable for her to stay on the Fed at that point? So I think there's also the question about, could she stay on the Fed if she was found guilty, even if the president was found to not have the authority to fire her?
You sit on the Bretton Woods Committee, Bill, and I really am trying to think more broadly here about what Fed independence means right now, given the fact that the United States has a huge deficit, and increasingly it is more pegged to Fed policy than ever before as it gets issued increasingly at shorter denominations. What does Fed independence mean when these are appointed individuals with inherent views on exactly how hot the economy should run and what the compromise should be when it comes to how quickly to bring down inflation to 2%?
So the way I would interpret Fed independence is it doesn't mean the Fed can do whatever it wants. The Fed has to basically follow the guidance of Congress in terms of its objectives. And Congress has said the objectives for the Fed are maximum sustainable employment and price stability. So those are the objectives. What Fed independence means is the Federal Reserve should be able to conduct monetary policy independent of political pressure to achieve those objectives. And the problem with, compromising the central bank's independence is that the central bank loses credibility. People start to ask the question, is the Fed cutting rates because that's the right thing to do, or is the Fed cutting rates because they're under political pressure? Obviously, the election cycle plays into the president's calculations, does not play into the Federal Reserve's calculations. And one reason why central bank independence has become very prevalent around the world is it leads to better economic outcomes. It allows the central bank to take the longer view, not to overstimulate the economy and run-ups to elections, and then not have to slam on the brakes after the election when inflation actually starts to be realized. So Fed independence leads to better economic outcomes, and that's why it's got broad support around the world.
Bill, appreciate your time, as always. It will be an interesting one in a few hours' time. Bill Dudley there, former New York Fed president. Neil Dutta of Renmac joins the programme a little bit later this morning, writes in, the sanguine nature of the bond market is a combination of the president is right about rate cuts, AI will bring down disinflation, and he won't get away with any crazy stuff.
Is this market that's assuming that this is a politically motivated Fed, that they're going to cut rates, that's going to keep everything kind of humming along, and no one's thinking about what happens if the economy actually isn't doing well and what that does to the broader risk asset sphere?
This Fed has been recklessly dovish for years. I mean, that's the Fed that this whole market's used to.
And it hasn't gotten inflation down to 2% for years
as well. Go. What's going to be changing?
Well, that's really the ultimate question, and that's what I'm really curious about over the next few months.
I'm with you, particularly on the balance sheet.
Yeah.
Anyway, we keep coming back to that. Up next on the programme, we'll catch up with Omar Aguilar of Schwab Asset Management. Neil Dutta of Renmac will be with us too, and we'll have that jobs data about 20 minutes from now.
This is still a tech-driven market.
Large cap U.S. market itself has been the place to be.
In general, things have been drifting more positive.
Valuations are toppy, but generally firms are performing.
Valuation is always in our mind, but at the end of the day, valuation alone is something that doesn't end bull markets.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Okay, this is it. I don't think I've ever done this before. 15 minutes away from the ADP report.
I'll remember this.
This is where we're at. All right, from New York City this morning. Good morning to all. The third hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures positive on the S&P by 0.15%, up by 0.2 on the Nasdaq. In the bond market, well behaved so far this morning. Sub 5% on 30, sub 360 on 2s, sub 420 on 10s, 418.58. And the next hour looks like this. 8:30 Eastern Time, jobless claims. But 15 minutes before that, the ADP report taking on additional importance over the last month.
Especially not only because of the firing of the BLS head after the last payrolls report, but also because revisions have actually brought the headline payrolls figure down to where the ADP is more consistently. So there's actually been more correlation than there has been in the past. Look, what we're going to get is the 1-2 punch that shows the low hire, low fire type of dynamic, the churn in the labor market that we have seen that has marked the past, say, 6 months. It continues. At what point do we reach a breaking point? And I wonder if when we look back on today's data, if the Challenger Gray and Christmas data showing low hiring plans from companies might end up being the most relevant data point of the morning.
Well, it's the second tier data, as some would say, but it's becoming more important because of also how people have basically just been putting some cold water on the first tier data, which would be tomorrow. But tomorrow, if we get sub 100,000 employment job growth added, that would mark the weakest stretch since the onset of the pandemic. And the question I have is this real weakening, or is this what Stuart Kaiser said earlier? Did corporate America take a siesta for 6 months and then potentially second half of this year, when all this policy uncertainty is basically getting wrapped up, we can actually potentially see corporate America go back to the labor market?
This is what he would call the sneaky bull case, the re-acceleration. I'm not sure how sneaky it is. Increasingly, that's what the market has positioned for since the start of August. A re-acceleration with small caps outperforming. I've talked about the home builders, the airlines. Banks came into September at or near all-time highs. This market's been positioning for exactly that bull case.
This is the conundrum, though. A lot of this has followed earnings, which also have re-accelerated. And the earnings growth has been better than expected, but it has come without a re-acceleration in hiring. So this goes to the questions around artificial intelligence, technology. Is there something else at play here where you could see profitability increase and not see commensurate hiring plans, not seeing it trickle out to the rest of the United States economy?
Some tension building there between jobs and this market, potentially. More jobs data 12 minutes away. Coming up this hour, we'll catch up with Omar Aguilar of Schwab Asset Management as stocks trade near all-time highs. Neil Dutta of Renmac as investors are gearing up for jobs data, and Subadra Rajappa of SocGen as the 30-year Treasury yield backs away from 5%. We begin this hour with stocks edging higher ahead of key reports on the labour market. Omar Aguilar, Schwab Asset Management CEO and CIO, writing economic uncertainty is still high, so think long-term. Stay disciplined, stay invested and stay diversified. No need to be a hero. Omar joins us now for more. Omar, welcome to the programme, sir. Let's talk about that economic uncertainty. How are you getting a clean read on the economy in America?
Well, you know, the big part of the trade-offs right now between inflation, unemployment, economic deceleration, and overall, you know, the path that we're seem to be going here, it is unclear how the consumers are actually driving the majority of economic growth. We have seen so far this K-shaped economy where the top end of earners continue to drive GDP growth, and the wealth effect coming from equity markets, coming from housing, coming from anything else seem to be very consistently supporting economic growth, where the other part of the economy, the lower income consumers, seems to be, suffering from, the pressures on inflation, the increasing in prices. So that sort of K-shaped economy seems to be the one driving a lot of this economic uncertainty, and the trend seems to pointing out towards deceleration.
No need to be a hero. I keep thinking about that. The implication is focus on quality, as you say. What does quality mean? How is the idea of quality changing, given the backdrop potentially of inflation, the backdrop given of slow growth with this sort of persistent price pressure?
Yeah, the big part here, Lisa, is that we have these forces that are sort of going at each other. Inflation seems to be very sticky and stubborn. We've seen the economic value and the unemployment being in these no hired, no fired situation. We see wage growth still ticking up a little bit, putting pressure on inflation, and something at some point is probably have to give up. What that means is that in certain way, the deceleration supports stronger balance sheets, supports discipline in management, supports capital expenditures, supports areas that define the quality of a company, where corporate America is using all the potential tailwinds coming from the economy to be able to manage their business in a way that is consistent with what the consumers expect, but at the same time have the potential for a sustainable, and that's the definition of quality, sustainable earnings growth. When you put that into context, that's where we refer us to say, look for those companies that allows you to stay invested, that continues to have strengthened the balance sheets, and that will be stronger even if the economy decelerates. So that's a big part of what we have on both, on fixed income as well as on equities.
Can you find more quality, more reliability in corporations versus governments right now?
You know, corporations have been very disciplined over the entire period since the pandemic. And if you actually look at a big part of the driver, you can see it in the credit market. The credit spreads have been incredibly tight. And most importantly, not only the level, but if you actually see the level of volatility of the credit market, is actually very surprising to just see that even though we have seen all kinds of uncertainty coming from headlines and everything else, we've seen that incredibly, well positioned for high quality companies where leverage has not been high. You know, obviously there are companies that have done it and that have been in the process of potentially, disappointing in terms of their future. But overall, that quality is being well reflected in credit. When you think about governments, deficits have ballooned, and you actually see what's going on in the UK, what's going on in the United States. You know, clearly, a little bit of that defense spending as well as capital expenditures that has been positive for the economy. It obviously puts a little bit more pressure on the long part of the fixed income curve. And you can actually see just that level of volatility that we see in the long end of the yield curve.
This is why it's so challenging when you look at what the Supreme Court has in front of them. This could actually impact potentially what bonds do, given the fact that trillions of dollars coming to the United States from tariffs is supposed to be depleting the deficit. Omar, if we were to see the Supreme Court strike down what is going on with IEEPA and the President of the United States, what would that mean for the bond market?
Well, first of all, the things that are actually very clear, the trend for the yield curve is to steeper. I think we are convinced, in our research that, overall the uncertainty in the long end of the yield curve, will continue. We see that even just in the last 24 hours, where we've seen volatility on the 30-year, yield on bonds, being, quite dramatic. And a lot of that is because A, inflation expectations, but two is also, what will be the long-term, views in terms of the deficit regarding, to the setup that may happen with the uncertainty of tariffs. It's kind of interesting to see that uncertainty of tariffs, started by affecting sort of the short part of the yield curve and now has been pushed towards the long end of the curve, precisely for what you just described, which is a big part of why, the middle of the curve seems to be the one that has been the most stable. And even when the yield curve, starts to steepen, you can actually still see some stability in that area.
It's become such a consensus trade, Lisa, the belly of the curve. How many people have come on this programme so far this year and talked about positioning in the belly of the curve and not wanting to go out any further? And
this kind of highlights the concern about long-term conceptions of investing, right? How do you invest long-term in a government? It kind of threatens the idea of 60-40 at a time when potentially, if you don't have confidence in a government going out and you're betting on your retirement package, say 10, 20, 30 years out, how does that kind of shift where you kind of mark-to-market things?
Yeah, Omar, appreciate your time. Omar Aguilar of Schwab Asset Management there with some important themes. The one you absolutely nailed, I think you're dead on. That's why we've seen the tightness in credit spreads. Or at least it's one of the reasons. Anyway, investment-grade credit spreads haven't been much tighter than they are right now over the last 2 decades.
Yeah, and this is the sort of idea maybe you could see corporations with a better creditworthiness, tighter spreads relative to Treasury yields, just based on the fact they've done better with their balance sheets and their business plans than maybe the federal government.
Got some economic data just around the corner, 5 minutes away. Going into it, 10s at 4.18, the lowest since May. Yields are lower this morning, now by 3 to 4 basis points. With an update on stories worldwide with your Bloomberg Brief, here's Yahira. Hey, Yahira.
Hi, John. Tech industry leaders are heading to the White House today. CEOs from Meta, Apple, Microsoft, Google, OpenAI, and more are all expected to attend an AI event hosted by First Lady Melania Trump, followed by an evening reception with President Trump in the newly renovated Rose Garden. Meanwhile, Republican Senator Tom Tillis says he wouldn't consider a replacement for Federal Reserve Governor Lisa Cook until there is a court decision on President Trump's move to fire her. Tillis, a key member of the Senate Banking Committee, told reporters he doesn't know if the allegations against Cook would qualify as cause. And Jannik Sinner heading to the U.S. Open semifinals after defeating fellow Italian Lorenzo Musetti last night. Now, if Sinner wins tomorrow, he would reach the finals of all 4 majors this year. And on the women's side, Amanda Anisimova beat out top-ranked Iga Swiatek, redeeming herself in a rematch of the Wimbledon final. Anisimova faces Naomi Osaka in the semifinals tonight. That's your Bloomberg Brief. John?
Serious redemption. Very, very cool to see that. Yahira, thank you. Up next on the programme, Neil Dutta of Renmark, with investors gearing up for jobs data. In a few minutes' time, it's the big one. ADP coming up next.
Historically, what's mattered most of all, it's the growth impulse, it's the inflation impulse, it's a predictable policy framework around monetary and fiscal policy. You know, a lot of those kind of core steady attributes of the macro environment are in historic uncertainty. It means that macro matters more than ever, cannot be ignored.
Mike Pyle of BlackRock in just a few minutes' time, 60 seconds away, a data point you used to ignore. Can you ignore it anymore? Equity futures on the S&P positive by 0.2% on the S&P 500, up by 0.3% on the Nasdaq 100, on the Russell, up by 1/3%. Turn to the bond market. 2-year, 10-year, 30-year, 10-year bond yields now down by close to 4 basis points, sub 420 at 418. 30-year bond yields backing away from 5% within a basis point of that level in yesterday's session. This morning down 4 basis points to 485.94. The ADP report lined up. The estimate in our survey, 68K. The previous number, 104. With the number this morning, here's Mike McKee. Good morning, Mike.
Good morning, John. I'm looking right now at the number. It's 54,000 jobs, according to ADP, comes in lower than the forecast you just mentioned of 68,000 and certainly down from a revised 106,000 last month. So this is not good news for the markets, and it is something that was foreshadowed by Governor Chris Waller, who noted that the Fed buys data from ADP on a weekly basis, and it had deteriorated during the months since the last jobs report. Taking a look at industry by industry, goods producing gained 13,000 jobs, but manufacturing lost 7,000. The gain was in construction of 16,000. And in service providing, we see trade and information services down 17,000, education and health services down 12,000. It's interesting, Omar Sharif of Inflation Insights putting out a note this morning saying, watch that social and education health services category, because that's been the one that's provided most of the jobs for this year so far. And if it's losing jobs, that is odd, and it is also not particularly good for the economy. Leisure and hospitality jobs made up the majority of the jobs that we got, 50,000 jobs for the month of August. So it isn't an overall great number, and I might just mention the pay numbers that they use for ADP. Job stayers got raises of 4.4%. Change jobs, you get 7.1%, fairly healthy. But how many people are changing jobs these days?
Mike, a picture of the economy over the last 2 days so far this week. Mike, if you put together the Beige Book, ISM, job openings for the earlier month of July, this data this morning, it's not a great read, is it?
It's not a great read. It basically shows you an economy that is kind of in stasis, not moving forward terribly, not moving back terribly. But the trend is what some members of the Open Market Committee have been talking about, and that would be concerning because the trend is towards slower growth and slower employment growth, which would feed on itself. So we'll have to see what we get tomorrow in terms of jobs and whether that tells the same story. Oh, and don't forget ISM Services at 10.
It's an important read. Mike, we'll be back with you in about 13 minutes' time. Jobless claims are just around the corner. Mike McKee breaking down the ADP report. That comes in a whole lot softer than expected. Equity futures stay positive. But, Bramo, this just puts a lid on this bond market, doesn't it? Just keeps a lid on yields across the curve. 10-year yields are down by 3 or 4 basis points.
Yeah, down at the lowest level since May 1st of this year. The irony is, Michael said that this was bad for markets. And maybe in the long term, if there is weakness, this will be. But right now, it is unabashedly a good thing for markets because they believe that it will give the Fed the reason to cut rates and that will be enough to generate some sort of momentum out of this stasis. But right now, you can see this. It's just sort of a grind to nowhere at a time with pricing pressures, and that's what the data is reflecting.
If you are just joining us, welcome to the program. This is how things are set up so far this morning. The number comes in softer than expected on ADP, 54K. The number we were expecting in our survey was closer to 70, 68K was the median estimate. In about 12 minutes' time, we'll have some more jobs data for you. Jobless claims are just around the corner. To discuss this data point and more, Neil Dutta of Renmac joins us now. Neil, welcome to the program. Just offer us your assessment of just where this labour market is coming into September.
Well, thanks for having me on, John. It's cooling, but not collapsing. So I think that's how you can sort of characterize it. I mean, it's a very, very sluggish labour market. And I think what's important is that consumers are telling us pretty clearly that labor market conditions are deteriorating. So if you look at the conference board, for example, jobs hard to get, that's climbing. And I think that's important because consumers tend to spot changes in their local economies in front of what BLS statisticians tell you, right? So they know about pink slips being handed out. They see the help wanted signs in their community storefronts. And if they're telling us that jobs are becoming increasingly harder to get, you should believe them. And that tends to lead the official statistics. So, my sense is that there's an ongoing sort of labor market slowdown that's already in train. I heard Mike McKee mention that construction employment rose 16,000 over the month. I mean, it's really hard to see why that continues considering construction activity is continuing to slow down. I mean, we're just coming off a month where building permits hit their lowest level, for the cycle. And so if there's less construction activity going on, there's obviously less need for construction payrolls.
Neil, I'm looking right now at the Russell 2000 futures, and I'm seeing them up on this data. And I am wondering whether you think that the risk markets are being overly sanguine about the scope of this labor market weakening that you see as being something that will ultimately be beneficial because rate cuts can save it. I mean, do you think that that's a sort of overly rosy outlook on things?
Well, I don't think, Lisa, that this is like last year, right? I mean, this is not a situation where some rate cuts are good. I think we're maybe entering a situation where the markets will have to price in more rate cuts, and that may not be so good because what that implies for earnings. So, this is not unusual. I mean, you typically see the markets rally, on the expectation of additional rate cuts. And then when it becomes clear why the Fed is cutting rates, then the markets tend to, get a reality check in that situation. So I'm not surprised by the equity market response, but, I wouldn't say that basically cancels the risk of a deeper slowdown in front of us.
What you're saying is really important, Neil. Are you saying that the 150 basis points of rate cuts priced in by the end of next year is not enough based on what you're seeing in the labor market?
Yes, that's what I think. I mean, 5 is like a very weird number, right? I mean, it's either too many or not enough. And I tend to think that it's probably not enough between now and the end of 2026. I mean, you have ongoing declines in construction. That's probable between now and the end of the year. You haven't really seen much of an increase in housing demand, even though mortgage rates have declined about 35 basis points over the last, 3 months or so. We had a meaningful juice to the economy from state and local government spending in the first half of the year, adding about 30 basis points to growth. Really hard to see why that continues into the back half. We're seeing lots of news around the country about, budget tightening across state and local governments. And with the labor markets slowing, that means that household incomes are moderating at a time when there's probably some upward pressure on inflation from tariffs. And so that means a further decline in real incomes, which means that consumers are going to have to cut back a little bit more. So, I think the economy is in a very, very rough spot. I think the news is going to get worse before it gets better.
When you talk about upward pressure on inflation because of tariffs, you have Steve Myron, who's going to be in front of the Senate Banking Committee today, saying on X last night, it's extremely difficult to argue that tariffs are causing any meaningful inflation. How is he going to explain that one to senators?
Well, I think what's more important, because Steve is obviously getting confirmed, I think what's more important is how that argument's going to hold around the table at the FOMC. I mean, if you're making the argument that tariffs are having no meaningful upward pressure on inflation, then that begs the question, why is inflation running above target? So I think it's much more important to kind of just focus on what's going on in the job market. And, the labor markets are cracking, and that's why the increase in goods prices that you're likely seeing from tariffs will be a one-off, because the nominal anchor continues to slow down. People do not have the ability, the wherewithal to absorb the higher prices. And that's what essentially ensures that you're not going to get, second round effects with respect to, tariff-driven inflation. And you'll probably see some squeezing in services as people cut back.
Do you think there's an argument, and maybe a number tomorrow would show this, that the Fed should cut by 50 basis points when they meet?
I think it's really hard to push that through, Annmarie. I mean, you could probably persuade me for a 50, but I don't think this is like last year, where what I thought the Fed should do and what they would do aligns. I think this is a situation where there's only so much the Fed can deliver up front. I mean, right now, the debate on the committee is, do we cut it all or do we cut twice this year? And, it's really hard to kind of nudge people along that don't even think they should be cutting this year. So it's really hard, in my opinion, to push through a 50 basis point move. What you could do is maybe, push folks in the direction of penciling in more rate cuts for 2026.
Now, just before you go, in about 45 seconds, if you can, you've got this right. Governor Waller has been getting this right. Chairman Powell's been playing catch-up with Fed Governor Chris Waller. What's helped you coming into 2025? What's guided you over the last few months, the last few quarters?
Well, I mean, I think it's just, first principles. I mean, if the Fed cut rates, right, and normally you'd expect housing market conditions to improve as a result of that. Guess what's happened? It's gotten worse. You've seen consumers tell you, that labor market conditions are still getting worse. I mean, when consumers tell you something, believe them. So I do think we're kind of, in this, soft spot for the economy. And I think it's likely, as I said, I mean, you just go down the list, John. I mean, consumer spending, which way is that going? Probably weaker. Residential investment, probably weaker. State and local government spending and investment, probably weaker. You can't just hold the entire economy up on AI-related investment. And let's be clear. I mean, that's also fungible. I mean, do we really think that companies are going to be spending as much as they have been on AI-related investment if advertising spending slows, if consumer spending slows? I mean, those numbers are not fixed points in space. I mean, I think it's all sort of part of the same ecosystem for these companies. So, I mean, that's kind of where I'm at. And we'll see what happens. But, generally speaking, my sense is
Neil Dutta, I've got to go. Clean shaven for ADP. That's how seriously you're taking it. From New York, this is Bloomberg. The opening about 60 minutes away, 30 seconds away from initial jobless claims. Moments ago, ADP came in soft, 54K against an estimate of 68. In the equity market, we stay positive by 0.1% on the S&P, on the Nasdaq 100 up by 0.2. In the bond market, switch up the board, 2-year, 10-year and 30-year bond yield to look like this, down by 3 basis points on 10s to 318.39. With the latest on the jobs market, with your jobless claims data, is Mike McKee. Good morning, Mike.
Good morning, John. Looking for the numbers to pop up here, and they haven't quite yet. We can say the trade deficit widens to $78.3 billion from $60.2 billion, and that's largely because we imported a lot. 5.9% increase in imports, 0.3% increase in exports. We'll get back to that in a second. Jobless claims now 237, a little bit higher than anticipated. The 230 was the forecast. Last week, 229. The continuing claims number, 1,940,000. That's down from 1,944. So some mixed numbers on jobless claims probably don't add anything to the narrative of what's going on in the labor market now. People will be more concerned about what we did see with ADP, only 54,000 jobs created. But I do want to go back to, for just a second, to the trade balance, because that's going to worsen GDP growth outlook for the third quarter, July, the first month of the quarter. And the imports up 5.9% after being down 3.7%. In June, suggests that there was another pull ahead effect of people stocking up on imports before the president put tariffs back on in August. So that's something to keep an eye on, the effect of all of this. If that reverses, we'll have a different kind of number for the month of August.
Mike, can we just stand this August data? So the 4-week average now on claims is 231. The number you just read out, 237, the estimate was 230. If you looked at all the other labour market indicators, Mike, they're not spanning a great story. They're not drawing a fantastic picture of the US labour market at the moment. And yet, Mike, jobless claims, if you only had jobless claims, you'd think this labour market was still pretty strong. Mike, is there a disconnect there? What do you think that speaks to?
Oh, I think it's just confirming the narrative that we've been hearing from Fed officials and from corporate leaders for quite some time, that they're not hiring. They're concerned for what's going to happen with tariffs and what's going to happen with the economy, but they're not firing either. They are, at this point, just trying to hold on to workers as long as they can, because if things suddenly pick up, they don't want to have to go through what they went through after COVID in trying to find people. Also, with the labor market in recent months slowing, growth in the labor market slowing, it could be even harder to find people. So they're going to hold on as long as they can. And that seems to be what's going on with jobless claims. We're also just at the period where all those federal workers who got fired but got severance might be coming off that severance. So it might pick up from there in terms of the government guys.
Mike McKee, great work as always. Michael McKee there, down in Washington, D.C., breaking down this economic data. So this is what we've got. Jobless claims came in at 237. That's the wrong kind of upside surprise against an estimate of 230. Continuing claims, which have been quite elevated over recent weeks, comes in lower than expected. So some conflicting information there, Bramo, maybe. But ultimately, claims are telling you one thing, really, really stable, very low historically. All this weakness is showing up elsewhere.
Well, Mike really raised it well, and he put it well, this idea of the low hire, low fire churn dynamic. Where you can see this is the unemployment rate among young individuals who are just out of college, the fact that they've got the highest unemployment rate ever outside of a recession. So where it's showing up is companies are choosing not to make hires that they traditionally would do. They're not firing, but they're not necessarily really expanding their workforce, as we saw that in the Challenger data earlier this morning.
Looking for that step down in jobs growth to continue tomorrow. The median estimate in our survey for payrolls is 75k. I've talked a lot about the range. The high is 144. The low is still 0. Can you imagine a 0 tomorrow morning?
I mean, what do you do with that? Is that bad enough news to shake the confidence in some sort of economic recovery? Suddenly, do we price in a 50 basis point rate cut in the following weeks? These are the questions that people will be asking.
I think the more interesting question is, can you imagine a 144? Something pushing 200. If we got something much, much stronger, that would feed this idea that we're getting this reacceleration. I see nothing like that in the data so far this week, with the exception of one thing. That subcomponent of the ISM manufacturing with new orders. Apart from that, there's not much to hang your hat on.
On the flip side, what if you get 50,000 jobs and then you also get the unemployment rate coming down? I mean, there are all of these sort of questionable sort of mixes that leave people scratching their heads saying, what do we do with that?
Let's throw some of these questions at David Doyle of Macquarie. David joins us now for more. David, welcome to the programme. A loan churn dynamic in this labour market. That's been true for quite a while, David. There's been a worry it breaks one way or the other and maybe in the wrong way. How are you shaping things up?
Yeah, look, I mean, obviously we have low hirings rate, low layoffs rate, and I think that's impacting the data in sort of broadly speaking in a lot of ways. The way we're thinking about it actually is, and I think it's the point you folks made off the top, is low labor force growth is I think a big factor here. And when we go back to look at what the economy was doing in 2023 and 2024, you needed about 200,000 jobs per month in order to sort of keep the unemployment rate stable. We think that number's come in a lot. It might only be 50,000 or 75,000 at the moment, potentially even lower than that. And I think that what that means is you can have months of low jobs growth, but still have a steady unemployment rate. And I think that's largely shaped the data over the past 2 or 3 months.
David, is there a contradiction here in the idea that companies are accelerating their profits while not necessarily growing their workforces? Does that have to change, or is this the new reality?
Look, I think I agree with the notion that things will break one way or the other. Like, I think we either see a deceleration eventually or a reacceleration. So I don't think that I would be cautious in terms of using the terms new reality. Now, it's possible that we stay in this regime for a few more months, maybe into the end of this year. But by 2026, we actually are fairly confident that you're going to see the economy start to reaccelerate as you get some of the impacts of the One Big Beautiful Act taking effect, and as you start to see, in all likelihood in our view, some of this policy uncertainty come in a little bit to give more confidence in the outlook.
It seems like a lot of people are talking about the economy breaking to the upside. How much risk is there of it breaking to the downside at this point, given that very few people are talking about that, and that's not what's currently being priced into risk assets at all?
Look, I think in the near term, there are risks of that. I think that there are headwinds over the next few months to real income growth, real wage growth from the likelihood that we get this tariff price pass through. That's going to weigh on real consumer spending. And so potentially you take a leg down. I wouldn't say a contraction, but certainly lower growth than what we've had in recent months or recent quarters. And so that slowing, though, I think paves the way for a reacceleration in 2026. So I think there's risks of a slowing, but I don't think it's all too severe. And I do think that things start to look better when we get to 2026.
David, you just talked about two issues in Washington. One, the One Big Beautiful Bill, and that could potentially be fuel for next year. At the same time, tariffs, which could potentially dampen the outlook for next year. Do they just equal each other out, cancel each other out?
Well, that's a good question. We'll assume for now that the tariffs remain in place, right? So there is some uncertainty in that regard. But if you assume the tariffs remain in place, they largely, pay for the deficit or increased deficit impacts that flow from the One Big Beautiful Act. In our view, actually, what we've seen so far this year has been a significant effective fiscal tightening from the implementation of the tariffs that's now causing a slowdown in growth. Once you get to 2026, that tightening, actually, you look at the math, it turns into an easing, right? So you've absorbed the impacts of the tariffs, but then you start to get some of the easing measures that were in place in the One Big Beautiful Act, and that can start to support growth when you get to the first quarter of 26.
Where exactly will we see that support from the One Big Beautiful Bill?
So you've got larger tax refund checks. We think that will flow through to consumers from no tax on tips, no tax on overtime, et cetera. The other element you could see it in is in fixed business investment, right? You get 100% immediate expensing and other business tax measures that were part of that One Big Beautiful Act. That could provide support in that regard. But, so those are the sort of the sub elements to it. But when we look at it, we just look at the broad fiscal deficit. The broad fiscal deficit has narrowed this year. When you look at the math for 2026, it's likely to expand, suggesting that the government spending and the fiscal policy becomes more supportive of growth.
David, can we just stay on this reacceleration theme? I just want to dig into that a little bit more with you. Is that a consequence of the rate cuts people are expecting? Or is this a Fed cutting interest rates into a reacceleration?
So look, I think it's a bit more nuanced than that. It's a good question. I don't think we're at the reacceleration just yet, right? I do think that there's some more headwinds to come in the near term. So the Fed is almost cut. If the Fed proceeds with cuts, in our view, they're doing it at the end of a slowdown type of period. Potentially, those cuts would contribute to a reacceleration later in the year. But to be quite frank, I don't really think that the effects will be all that significant. We're not talking about a dramatic shift in policy. The market's already pricing in the cuts. I think delivering, 25, 50 basis points through the end of this year isn't likely to move the needle too much on what we're looking for in 2026.
And just quickly, what's the number you're looking for tomorrow?
Always a mug's game to forecast the monthly payrolls number. I'm going with 100,000. A little bit above
100K. And do you consider 100K in today's environment a good number? Is that more of a structural story and less of a cyclical one?
So it's a structural story, yes. And given the low labor force growth that's currently being experienced, 100,000 jobs in a month could be consistent with a tick down in the unemployment rate. Not saying that we're going to get that, but it could be consistent with it.
Something to think about. David, thank you, sir. Appreciate it. David Doyle there of Macquarie. That was the scenario that you were leaning into before this conversation started.
Because of the low turn kind of dynamic, that even just a little bit of job creation could end up with a lower unemployment rate. The point you are making, is the Fed cutting into a reacceleration, or is the reacceleration on the heels of the Fed rate cut? I'm still thinking about that because ultimately that determines inflation, right? I mean, if they're cutting into a reacceleration, could that just juice things in a way that would allow price increases to become more entrenched?
And juice this market too, a market that's rallied pretty hard coming into September. Equity futures still just about positive on the S&P going into the opening bell 50 minutes from now. Let's get you an update on stories worldwide with your Bloomberg brief. Here's Yahira. Hey, Yahira.
Hi, John. A recap of this morning's labor market data. Hiring at private sector jobs slowed in August, with ADP data showing 54,000 jobs added in the month. That's roughly half the pace of the prior month and below the median estimate of 68,000 jobs. Elsewhere, weekly jobless claims rose to the highest level since June at 237,000, adding to evidence that the labor market is cooling. Meanwhile, Russian President Vladimir Putin told his Ukrainian counterpart Vladimir Zelensky that he should come to Moscow to hold peace talks. Putin, who was attending Beijing's massive military parade on Wednesday, also claimed he never refused a meeting with the Ukrainian president. And the NFL season officially kicks off tonight with a matchup between the Dallas Cowboys and Super Bowl champions, the Philadelphia Eagles. But NBC is the big winner. The network said this season will be its highest grossing yet, having already sold out its ads for the Super Bowl in February. It's also said 90% of its ads inventory for Sunday Night Football. That's your Bloomberg Brief. John?
Some serious money. Yahara, thank you. Appreciate it. Up next on the programme, Subadra Rajappa of SocGen, as the 30-year Treasury yield continues to back away from 5%, and we count you down to an important hearing on Capitol Hill with Stephen Myron from New York City. You're watching Bloomberg TV.
It's a very, very sluggish labor market. And I think what's important is that, consumers are telling us pretty clearly that labor market conditions are deteriorating. My sense is that there's an ongoing sort of labor market slowdown that's already in train. I think we're maybe entering a situation where the markets will have to price in more rate cuts, and that may not be so good.
That was Neil Dutta of Renmac on the programme with us a little bit earlier, following a downside surprise on ADP. The jobs number came in at 54K. The estimate was 68. Jobless claims, the wrong kind of upside surprise, 237 versus an estimate of 230. Still jobless claims pretty stable at the moment, given the picture elsewhere. The picture elsewhere hasn't been great for this labour market so far this week. Equities look like this going into the opening bell. Equity futures still positive by 1/10% on the S&P. On the Nasdaq 100 up by 0.1 also. In the bond market, things stabilise a touch. Down 2 basis points at the front end of the curve, 360 on twos, as this market positions for more rate cuts from this Federal Reserve. Sticking with the Fed, Subadra Rajappa of SocGen remaining slightly cautious, writing this. Well, the hope is for lower policy rates to stimulate the mortgage market. That could backfire. We could see a repeat of last September when a 50 basis point rate cut resulted in higher long-end yields. Subadra joins us now for more. Subadra, good morning.
Good morning.
Going to pick up on the line of questioning that we finished the last interview. Is this Federal Reserve cutting into strength?
It feels like it, because if you look at a lot of the data that's come in, economic surprises have been to the positive side. The growth momentum into the second quarter is also on the positive side. Inflation is high and sticky. The job market, as Mike McKee was pointing out, there's no hirings, there's no firings. It's in a state of stasis. So to me, it feels like that, plus all of the fiscal stimulus that could potentially come down the pike, could be something that could move the markets higher. So it feels to me like some of these cuts that are priced into the market are more preemptive than really something that's warranted.
Is this something that's tradable now, or is this just sort of warning shot ahead of what could be a tumultuous couple of months?
I think so. I mean, the market's pricing in nearly 6 cuts between now and the end of next year. The markets, people are looking at, a cut and maybe 3 cuts this year. To me, it feels like if they cut sooner and more aggressively, they won't be able to cut as much next year. So the neutral rate is going to have to be a lot higher, given the fact that inflation is still high and sticky, and the risk is that you could see a reacceleration of inflationary pressures. So the market, to me, feels like it's overpricing cuts between now and the end of next year.
Even with the political impetus, right? I mean, how do you sort of overlay any kind of political interference with this, given that right now this is a Fed that has a dovish bias and might have an even more dovish bias by the time we get around to 2026?
So that's the part that's tricky, and I think that that's part of the reason why the market's pricing in 6 cuts by the end of next year. So the market's really looking at what the Fed could do as opposed to what the Fed should do. So to me, it's very hard to really kind of separate the two aspects. One is, if we have a very dovish committee next year, that could really change the dynamics in the market. But over the long run, that, to me, leads to Fed credibility. A lot of times we look at the market and say that, the bond market is very complacent right now. Volatility is very, very low. But you could see a pretty significant sell-off in bond yields in a very short amount of time if there is a crisis of confidence.
But there isn't right now. How much are you going to be watching this Stephen Myron Senate confirmation hearing just to really, as Terry Haynes put it, read the body language of the Senate, which at the end of the day, the purview of the Fed does belong to Congress?
Yeah, I mean, it is important. We will be paying attention to what he's saying, but it's really a committee decision as of now. It really depends on what the composition of the committee is going to be next year, who President Trump nominates to be the next Fed chair. So again, there's a lot of uncertainty, but there's a lot of complacency, I think, in the bond markets. Just going back into the last, say, few years, we've seen many episodes when when bond yields have risen sharply. We saw 100, 150 basis points of bond yields rise after, August of 2023 when, the Treasury issuance, coupon issuance sizes changed. We saw a pretty decent sell-off in bonds even last year when the Fed cut rates by 50 basis points. So, to me, it feels like there is just that feeling that everything is going to be status quo when there's just a lot of uncertainty coming down the pike, whether it be Fed independence, whether it be the trajectory for debt and deficits, not just in the U.S., but also globally, and other kind of, extraneous factors like tariffs and that working through the legal system.
I think you're building a credible case, but what's been surprising for me is just how stable the Treasury market actually has been.
Yeah.
Yes, we've had steepening in America, like we've had steepening in Europe, but this steepening has been completely different. It's been led by the front end. 10s and 30s have been really resilient relative to some of the chaos in France, some of the chaos in the UK. What's supporting the Treasury market right now? Maybe that's an interesting question to ask. What is supporting this? What is keeping 10s at 420, 30s away from 5%?
So I think that when you look at the composition of where people can invest, I mean, clearly the front end is pegged to Fed expectations. The market is pricing in, as I said, a lot of cuts over the next year and a half. And then when that trade's maxed out, investors kind of move on to the belly of the curve. And the belly is really where you've seen a lot of the flows. I mean, the 2-5 curve actually inverted a few times. You're seeing a lot of demand for the 5 and 10-year part of the yield curve. And investors, broadly speaking, are concerned about putting money beyond that 10-year sector because there's a lot of volatility in the very long end, not just from the debt and deficit trajectory for the U.S., but also what's happening globally. You're looking at, the picture in Japan or, the political, unrest in France. That all argues for higher long-end yields. So really the center of gravity for the Treasury market seems to be the belly of the curve.
So last year, they dropped rates 100 basis points. Yields rose at the long end by 100 basis points. What are you actually looking for into year end? What kind of number?
To me, it feels like the 10-year yield is still going to stay between 4 and 4.5%. Yes, to me, the risk is that we might actually start drifting towards 4.5% if the market starts to get concerned about kind of the inflationary, impact of tariffs that feeding through, or if there's any sort of concern over Fed credibility. But, the different sectors of the yield curve are still going to remain range bound. Where I'm really concerned about yields getting unhinged is in the very long end. I think 30-year yields could very easily get to 525. I mean, we saw a lot of volatility in just this week in the 30-year. So it's very conceivable that you start seeing, that sort of, concern play out in the very long end of the yield curve.
Saw a massive range yesterday in just yesterday's session. Subadra, appreciate it. Thoughtful stuff as always. Thank you. Subadra Rajappa there of SocGen. 30-year bond yields very close to 5% in yesterday's session, within a basis point. Now back down to about 4.87 and down 3 basis points on the day. Let's talk about the big event. It takes place in about an hour and 7 minutes time. Fed pick Stephen Myron preparing for a grilling on Capitol Hill. Tyler Kendall joins us from Washington for more. Tyler, walk us through the procedure here, the process down in Washington.
Yeah, hey, John. So Stephen Myron will be in front of the Senate Banking Committee starting at 10 a.m. Eastern. This is the first step in what we're expecting to be a pretty expedited confirmation process for Myron. And today the spotlight's going to be on him and his bid to try to reassure lawmakers that he's committed to the central bank's independence. But I'll also point out that we are closely watching some key senators here, because this is really going to give us a rare glimpse into how some of these Senate Republicans are balancing their prior support for Fed independence with their current support for President Trump. And while we're not expecting any Republicans to vote against Myron, I will say my eyes on some key ones like John Kennedy, Mike Rounds, Tom Tillis, who actually met with Myron last night, because these have been the lawmakers that are perhaps a little bit more staunch in their support for the job that Fed Chair Jerome Powell has been doing. Now, with that said, we got the prepared testimony from Myron. He's going to give brief remarks before he takes questions. And in that prepared testimony, as you've been covering all morning, he says he's going to be committed to preserving Federal Reserve independence. But with that said, we know that there's this paper that he authored last year where he suggested that there should actually be more presidential control over the central bank, putting forward some perhaps controversial changes, including potentially changing the term limits of Fed governors and subjecting the central bank to the congressional budget appropriations process. John, at this point, Democrats have conceded privately to us that they don't have a lot of procedural options to really stall this vote ahead of the September FOMC meeting.
Tyler Kendall with the latest. Tyler, thank you. Looking forward to the coverage down in Washington, D.C. As we've said a few times, credibility here is important. And it's not about gaining credibility with the people in the room. There's an obvious and clear political divide down in Washington, D.C. No point even discussing that. It's about having credibility with the market. And as Neil Dutta said, having credibility as well with your future colleagues, some of which are still very much on the fence when it comes to September and cutting interest rates.
Given some of these big questions, you pointed out that Treasury yields have been remarkably stable. So while people are fretting about it, there has been a stability in the bond market. I ask why, and it's because of this two-sided risk. On one hand, you see the labor market data coming in soft enough to get people worried that maybe things could break to the downside, while people are thinking, well, hold on a second, maybe this is going to be a central bank predisposed to running the economy hot, which could be the other way around, cutting into a reacceleration. That is the tension keeping things in stasis.
When it comes to credibility with his colleagues, it's going to be very challenging in the sense that this is someone who also wrote a paper about the revolving door between the Fed and the White House.
Yeah.
There's an open question that maybe he goes back to CEA after the short stint at the Fed.
That hearing an hour and 4 minutes away. Coming up tomorrow, full coverage for you. Chris Verona, Stratega, Sarah House of Wells Fargo, Nadia Lovell of UBS, Stephanie Roth of Wolfe Research. The jobs report up next.